Thank you very much. And let's just give a round of applause to the organizing. Thank you very much. This makes me think, and I think it sends the same message to everyone, that all the sessions, indeed, all the sessions were fruitful, and that the message was passed across. Because all of the lessons all the takeaways that we just heard tackle the 5 topics of discussions that we had. So just as a quick reminder, we started off with the performance of the pension sector amidst COVID-19 that was presented by Himanshi. And then we went on to discuss the future, and then we continued with green and sustainable finance, where Mrs. Dorothy really was kind of inspired to go think of new products and not
in Kenya and East Africa. Hopefully in the next 1 year or so, we'll be able to make announcements on that once we succeed in the capital raise. So let me stop.
Banking outfit based out of London, but with branches and offices all across the emerging markets. I am part of the advisory team that's of course deepening financial markets across. On one part, what does the landscape look like? Because I don't think there had been, cohesive body of work that has tried to look at how the market looks like, and that's the private debt market. We also were talking to quite a number of stakeholders. Part of the job is also to try to test demand on the private debt. What structures actually attract people to this? And in the course of it, we had quite a number of interactions and with a variety of stakeholders. We talked to, from investment managers to investment bankers, people who structure these deals, to regulators. And I think the whole point was to try to get, a proper feel of what the whole ecosystem views in terms of private debt. Our focus, of course, was very Pan-African, but we also understood that there are some markets which are probably slightly ahead with a bit of experience. Why don't we use those as a sort of sourceware of material to deep dive into? That includes Nigeria, Ghana, Kenya, and Morocco, and then benchmark that against South Africa, which, obviously is pretty much ahead compared to other African markets. So I think it behooves us to sort of take a step back and ask ourselves what private debt is. And I think one thing which we really need to focus on is the fact that private debt is debt by definition, but it's non-listed. And it really looks at debt provided by non-bank lenders and outside, of course, of what is publicly listed. It's important to define that spectrum of potential lenders, because sometimes somebody might ask, why isn't a private loan agreement between isn't a loan agreement between a bank and an individual a private arrangement? It is by definition, but private debt specifically leaves out financial players in the sector, and that's banks for that matter. I think we also try to look at a few other characteristics which also help you define this a bit better. So of course, one of that was the lender-borrower relationship, and clearly there is a direct relationship, and the negotiation and the arrangement is on a very bilateral basis. And the other thing which you clearly see across the board with private debt structures is they're very bespoke. It's very aligned to what the particular borrower wants. So it's basically the lender and the borrower working together to come up with an arrangement that makes sense to them. Of course, there is an element of it being perceived or otherwise to be of higher risk, and then there is limited liquidity. A private debt is not necessarily listed, so you can't necessarily say, okay, fine, I'll go, sell the debt down to other people. It's basically pretty private. The other thing, again, which we also wanted to talk through is contractual terms. I think, as Evans mentioned, unlike private equity, there is a very clear, predictable stream of flows or cash flows or returns that go towards the lender. So that's very clear. In other particular credit structures, for instance, mezzanine, you have a lender giving in debt, but also can take a certain upside if, for instance, a company performs well, and on the equity side as well. So moving on quickly, why private debt? I think one thing to mention is the private debt market, of course, in the more advanced economies is pretty high, is pretty large as a sort of asset class. You have up to around $172 billion of annual issuances, and that's having looked back at the past 5 years. If you were to even go back historically, pre the financial crisis in 2007-8, you're having years where you're having issuances in the private debt market of $300-400 billion a year. So it just tells you how big it is as a sector or as an asset class. The other thing which you get to see is also the private debt in Africa is pretty small. It's something that is growing as a sector. We have a major financing gap. When you talk about this 52 to 92 billion of annual funding needs, we definitely could use from sourcing funding from any other source of funding other than, of course, the traditional markets. What you see on the graph on the right just tells you the profile of how the private debt market in Africa looks like. And it's worth mentioning it's very dominated by DFIs and MDBs. So if you look at all those logos, you can associate them with particular governments. So you have CDC, which is now British International Investment, and DFC, FOMO, No Fund. These are the guys who actually are the majority of funders within the private debt space. There are also MDBs. So if you think about the multilateral development banks, they're also major players in this sector. When you look at the strategies that are employed, I think the major strategy, of course, is direct lending, which is typically in form of senior debt. You also have mezzanine funding that comes through there, but most of the time mezzanine funds are very specialist and run this in a very particular way, in the sense that they are very picky in terms of what they invest in and really look deep to understand their potential borrowers. There are also other more sort of specialist space. The thing which is worth mentioning, especially in this particular forum, given that we are in Africa and there is a very big demand for local currency, is the fact that given the fact that we have a lot of the investors right now who are mostly MDBs and DFIs, the offering is very, very skewed towards hard currency offering. And that in itself is a problem, because it basically limits the depth to which the market could grow. It definitely limits it to borrowers who could possibly take the FX risk. It doesn't look at borrowers who probably have local businesses, who don't necessarily have robust sources of FX. So in a sense, this presents a definite opportunity in terms of growth for the sector. Just to build a bit on the private debt space, I think there is, we try to size the market and sort of come up with a good idea of where we think the private debt space is. So, after sort of compiling from a number of sources, we think, especially in Africa, the private debt market is around currently 37.5 billion. That's basically what's outstanding. A bulk of it, as you can tell, is really skewed towards multilateral or MDBs, or development banks, and DFIs. You also have private debt funds, but as you can tell, they only occupy a small portion of our market share at about $8 billion. I think when it comes to the structures, as I mentioned, I think for what we see is senior debt being the biggest portion of the private debt market, and as rightly so, given the fact that, again, this is private debt, and investors or lenders have to feel some sense of comfort using, and the senior, of course, structure is comforting in a sense. We saw a number of transactions where we couldn't be too clear about or, how big or what type of strategy is employed. And then mezzanine is also a growing piece of the private debt market at about 1.4 billion. And of course, there are the others in terms of junior debt, special situations. All the others are accounted within the smaller 0.1 to 0.0 billion dollars. When it comes to the sectors, and this is something worth mentioning, I think there has been quite a bit of investment in private debt in the power and energy sector, and you just need to look at what the MDBs, for instance, IFC or not IFC, for instance, Africa Development Bank, are focused on. So there is a very huge focus towards power and energy. If you look before that huge focus on power and energy, there was quite a bit of focus on financial services, so and deepening financial services. So there's quite a bit of funding going towards financial services, all the way from your micro lenders to MFIs to smaller banks to the larger banks. And then we are seeing a bit of activity, for instance, in oil and gas and mining in countries like Ghana, and in real estate and across the board, that is. So quite a number of mezzanine funds, which we were in constant touch with, are looking at real estate as a sector for them to provide private debt. So we try to also capture some of the trends that we are seeing in the private debt space, and we looked at a number of funds that are currently in the market going out to raise capital for private debt type strategies. So it's worth mentioning Africa Go Green, which happens to be within the Lions Head family, is a fund that is has just reached its first close in 2021. It's a fund that looks at investing in decarbonization type strategies, basically looking at green buildings, at looking at retrofitting factories to make them greener. So very wide sector focus. And that kind of tells you again why there is a private debt space, because if you were to take certain deals or deals like this to your typical commercial bank, given that they don't have the specialists in-house to assess this type of deals, they might not necessarily look at it. Similarly, Vantage has just finished closing on its mezzanine fund, again looking at mezzanine type structures across Africa and across different sectors, similar to Blue Peak as well. And the last two funds are off-grid energy funds. That's Sanfanda and Facility for Energy Inclusion, which are also very focused on energy. Again, just to underscore that point, that private debt exists for a reason, and the reason is mainly because there are certain bits of, or certain parts of, or sectors of the economy that require sort of specialist thought and in terms of structuring, in terms of understanding the credits, that your typical traditional lenders might not necessarily look at it. So hence the reason why you see all these funds with very specific strategies looking at opportunities across Africa. So just to give you an idea of what we saw when we met with stakeholders, and these are just a few of the key highlights. There's quite a variety of views, and I'd invite you, of course, to look at the full report, which I think FSD Africa would be in a position to share. But just to highlight on the key issues, I think on one part, the regulatory environment, and this being sort of a supervisors forum, it's important it is discussed. So certain institutional investors, of course, have restrictions in terms of the instruments that they can get to. And for instance, we looked at Morocco, where it was very clear that for institutional investors really can't put in capital towards private debt, and these are pension funds for that matter. I think there is a very clear public sector focus and of course in investing in public debt. So there is definitely a need for a review of the regulatory environment and seeing how best to make it easier for institutional investors, of course, to judiciously invest in private debt. The other thing, of course, is the yields. So, and this is a pretty personal experience. I mean, being a banker and taking deals in front of pension funds. I think when people look at the yields offered, you know, in comparison to what, for instance, the government offers, there is always a bit of pushback, especially from fund managers, as to why, what's the motivation? What really would it make it worth their while to look at a private debt deal and really assess it deeply, while on the other hand, there are, you know, government securities which have attractive yields that they do not necessarily have to put in as much work, or they're comfortable with the credit profile that they're happy to put in funding into. So I think there definitely is an issue on that part, which really speaks to what can be done better to structure deals to make them more attractive to potential investors. The other thing is data. I don't think there is as much data out there that would help potential investors feel comfortable in terms of understanding, okay, this is what has happened historically, and this is what we could expect if we were to put in or set aside funding towards private debt. So I think there is something that needs to be done to, of course, improve access to data. Again, on risk management, and Evans alluded to this, I think there is definitely a need to figure out, especially in these early stages, how best to incorporate capital protection measures. This could be, you know, fast loss mechanisms or guarantees, just to give the much needed comfort to get especially institutional investors in Africa across the line and investing here. And then across the board, something which we felt there is an issue with is capacity. And this is across the whole spectrum, from the point in time where, you know, deals are being generated to the point in time where deals are presented in front of investors, and capacity within the investment community to assess these deals and you know, do them justice in terms of really getting a good idea of whether it makes sense to them or not, and having a very clear picture in terms of the credit risk to be taken. I think one of the key recommendations, which we will, and I think Evans will touch on a bit more, is the need for credit enhancement facilities. I don't want to dig too much deep into that because it will be covered a bit later. And then I think there's need to increase data access, and this is either within the private debt community, sharing data on what's going on, what's been issued, how has it performed, so that it gives people in, or the whole stakeholders, from, you know, regulators all the way to investors, an idea of what's going on in the sector and how well the sector performing, and it sort of gets them to a level where they're a bit more comfortable. I think there is a need to develop and seed a lot more local currency investment type vehicles. This could be risk takers, basically investors in the specifically focused on private debt opportunities. It could be it could also, these vehicles could also, of course, provide credit enhancement as part of their suite of products. And it could also help in terms of developing sort of local capacity in terms of developing a pipeline for potential private debt opportunities. And capacity building, need not mention it, but I think there is definitely need for capacity building across the board. There are few initiatives that we saw that are sort of building this capacity. In Kenya, we have this group called CAPFIC, that's a Kenya Pension Fund Consortium, that's you know, sort of helping pension funds as a group to look through deals and in a sense screen them before, of course, they go to their respective, sort of asset managers, and in a sense gives that comfort that yes, somebody looked at it, it's moving through the paces, and ultimately, when a decision is made, there has been some socialization and analysis of these opportunities. In Morocco, we also got the feel when we spoke to the regulator that there is need for, from also a regulatory perspective, capacity building, getting them comfortable enough to, if they need to develop regulations, develop the allocations or guidance around the allocation towards the private debt market. So that's it. It's pretty brief, but we've tried to capture as much as we can from that, and I think we're moving now to the panel session. Thank you very much. So I would like to use this opportunity. Thank you. Yeah, I'd like to use this opportunity to invite Victor and Anthony. Please come to the front. Okay. Thank you, gentlemen. So, probably everyone knows you here.
Yeah, actually, I don't need...
a need for expertise in investment committees of boards of trustees, because as a pension community here, you understand that some board of trustees also have investment committees which report to the main board of trustees, and there's an awareness and a skill set gap which needs to be filled up, and forums like this help a lot. And thirdly, and it was mentioned by Chris in his presentation, across the continent and specifically in East Africa, we have to admit there's a dominance of government debt. Treasury bonds have almost been the default debt security, but here there is an alternative for that. Thank you.
Okay. Thanks a lot, Anthony. And just as a follow-up, what do you think, or how best do you think regulators can help in terms of addressing some of these challenges, that you mentioned, from a capacity perspective, from a regulatory perspective? How do you think they could help?
Yes, that's a good question, Chris. And most of them are here. They can help in two simple ways. One is to make it simpler for pension boards of trustees or managers by providing board of trustees and also to us as fund managers. And that will help a lot. And if you're uncomfortable, there's all the capacity which regulators can get to make that guideline very expressly stated and clear to the users or to the pension fund. Secondly, a lot of regulators here have requested for, or have made it mandatory for boards of trustees trainings before an individual becomes a trustee or their own towards their trust.
Pension industries to actually identify investment in those space. And I also know that some of those investments, I know that they are such that they embrace ESG.
I argue that investments are always risky. And one thing we have learned over the years as pension fund administrators, or pension scheme administrators, we've had situations where they have consistently.
Of course, what we should also be discussing is the entry point for pension funds. Perhaps getting into direct investment might be a bit more challenging, I guess, but it could be possible to go through funds, private debt funds, so that you have the comfort of investing through a fund manager who is experienced. In some cases, we are also hopefully encouraging co-investment. So, for example, if there's an infrastructure project, maybe IFC, BI are invested, pension funds can come alongside, because one of the challenges we are facing in this space is that a lot of the investments are in hard currency denomination, yet some of those projects are not necessarily generating hard currency revenues. So having co-investment where local pension funds can provide the local currency component in the financing is very good. And then finally, the final point I wanted to make also is a lot of these projects are already existing. Many of them have gone through the construction risk. So now they're basically operating assets. And so therefore, pension funds don't necessarily have to take a construction risk in the process, and they can be able to hopefully come in if there's some refinancing of some sort, and enjoy long-term returns that are very secure and very stable and all that. So I do hope that over time it's a conversation. We will be able to bank this myth that this is a risky asset class, because if it was risky, we'll not be seeing all the DFIs and others coming into that space. And there are also structures, as we mentioned, that can de-risk that through first loss provisions, through credit enhancements, or even total wraps on the structures and all that. Yeah, so thank you very much.
Yeah, no, I think we only have, I guess, one room for one more question, just given their time constraints.
There is one already here.
If you insist, please go ahead.
I'm not insisting, but there's one already.
Go ahead.
Thank you, Chris. I'm personally pleased to have keenly listened to the discussions, particularly on private investment of the pension fund. But I'm skewed, my contribution is skewed towards the subject matter of this conference, resilience and sustainability of pension funds. I am a pension administrator, the day-to-day admin of the National Social Security Insurance Trust lies on our shoulders here. And we are governed by an act, and that act speaks volumes of what the investment type our funds should be. And given what I've heard and the opportunities in private debt, to some extent, one could say it's a bankable approach. But the question here is, if we are talking about overregulation of the pension field, which actually protects the yield and speaks to the securitization of the fund, what effort is this group, as investors that are advocating for public debt, what are the efforts that you are putting in place to comfort pension administrators that the funds, A, if invested in private debt, is secure, and secondly, two, how far have you designed programs that could raise the awareness of private debt to trustees? Somebody, I guess it's Chris, who mentioned about the capacitation of trustees board in terms of private debt. Because in this part of the market, there is ample room of lack of awareness amongst those that administer pensions, particularly public funds, statutory funds, because of the appointment of those trustees. At home, we have a tripartite board from different stakeholders. So I just want Chris in particular to comment on that angle, how much the team is looking at trying to expand their advocacy, particularly in terms of regulating this field of the pension. Thank you.
Yeah, thank you. And I think there are two questions there. So I think the first point was around comfort, which partly Evans covered it around, on one part, credit enhancements. And what we recognize in most markets, we recognize that the way to get in or to get people to be comfortable with private debt is for it to be credit enhanced. And the credit enhancements start from 100%, where, as your colleague mentioned, you are at least certain of the principal amount, that you don't have a loss of the principal or seed capital, as he mentioned. So I think I view it as a long-term journey. That's something that you start off, especially in newer markets or markets which have actually suffered defaults. I've seen that in Kenya, where we had defaults of corporate bonds, and now for anyone to touch a corporate bond, it had to take corporate bonds to be 100% guaranteed, and progressively people are getting more and more comfortable with the credit risk going forward. I think when it comes to the programs that build on awareness, I think this is a question that's more in the field for FSD Africa, and I know they're working very hard towards that. As Evans mentioned, there is a whole program that's looking towards deepening both the private equity and private debt markets, and capacity building and development of awareness across the whole sort of ecosystem, with all the stakeholders is a critical part of it. So I'm pretty sure you will be hearing more from Evans on that particular one. Yep.
Just a quick one, a very quick one on that. So we've been working with the Africa Venture Capital Association, and we've supported them to establish what they call the Africa Academy, to provide a lot of capacity building to fund managers, trustees, and all that, to understand the private capital markets, private equity and private debt markets. So I'll be very happy also to discuss offline how you might be able to assess some of that training that is provided through the Africa Academy.
Maybe, Chris, I can add something on that. Maybe I might be the person on this panel who has spent all his life with trustees. And I can feel the concern, which is definitely, the basic concern for any board of trustee, or a trustee for that matter, is exactly what has come from the two gentlemen, is safety. Because the three main pillars which anchor the pension industry globally, and even in the continent here, is what will be alluded later before lunch. And I think we are very fortunate to have Sandeep Richura from Zamara, who has spent all his life trying to allude on those facts. One is adequacy and coverage of pension schemes. The second one now is critical here, is how regulatory environment brings safety. And thirdly, where I spent my time, is on investment opportunities. Now, one of the key things which has made investment opportunities be scarce is exactly what FSD Africa is working on: awareness and skill and knowledge. But the bigger part is not the skill and knowledge, is what? Is awareness. And the awareness is not needed only by board of trustees. It's also needed by supervisors or regulators. And a forum like this gives them a huge opportunity to listen and create enabling regulatory environment for these unique investment opportunities to come through. I can assure you, as a fund manager, that private debt, if it's not less riskier, it's almost equivalent in risk return or risk perception, just like government debt. In addition, you've heard about the enhancements, but I'll also want to let all the trustees or pension administrators who here know that as a pension industry, we have the burden of seeking for the highest return at the lowest risk. That's what I hear every day when I talk to boards of trustees: the highest return for the lowest possible risk. Now, the discussion on private debt here is actually trying to provide that. I mean, when I hear those returns of 7 to 20% in dollar terms, they're not achievable in any African local currency. So you can see the opportunity, but we need just to work on the awareness, because the awareness is actually the risk, it's not the instrument. The low awareness is actually the more driver of the risk. Thank you.
Okay, thank you. And I know we are out of time. Apologies for going over by a couple of minutes. So I'd like to thank the panel and, of course, the audience for asking really good questions. Yeah, I think that's it from us. Over to you.
Thank you.
Thank you very much. Thank you very much, dear panelists, and Chris for being right on time and for a great discussion that you just gave us. Now, we're going to take another 1 hour for our second discussion before we go on our first break of the day. This discussion is one that was also alluded to yesterday during our different discussions, and I believe that it's going to be as exciting and thought-provoking as the other ones. So with that, allow me to welcome Mr. Mr. Goodam Bardwaj. He's a social entrepreneur, digital micropension inclusion. He's a Nashoka Fellow and the co-founder of Pinbox Solutions in Singapore. Mr. Goodam is going to be followed by Mrs. Parul, Director of Pinbox Solutions, to moderate the next sessions. Give it up for Mr. Goodam. You're welcome on stage.
Could I get a clicker, please? Okay, while I get control on my slides, good morning, everybody. It's absolutely wonderful to be back at this forum. And I think this is a hugely important forum, which I think will, oh, thank you so much. Which will galvanize the way, you know, pensions are regulated, administered, and delivered to citizens. I work at Pinbox Solutions. Basically, we're a global social enterprise and a pension tech which works in different countries in helping governments, regulators, and mainstream financial institutions to increase pension coverage, especially among informal sector, non-salaried informal sector workers. And I'm hugely delighted to be back in the land of 1,000 hills and 1,000,000 smiles. Just till Saturday, I was, thanks to CEO Martin from Urbra, I was at a meeting in Kampala, and then went to Delhi and then came back. And it's very nice to be back in East Africa, even with very high frequency. So at this point in time, we are working in, I mean, we've had the privilege of helping the government of Rwanda and AFR on designing, building, and actually launching the Ejoheza. We've also working with Zamara in Kenya on doing a similar program. We've had the privilege of working with Martin and his team in Uganda in designing the framework and the blueprint for an inclusive pension arrangement. We've also worked in India, Bangladesh, Singapore, Nepal, Indonesia, etc. So let me just, I have a problem with brevity, and I have my CEO moderating the session. So I'm trying my best to put in, you know, be as crisp as possible, though I don't promise any useful outcomes with that. But, okay, so this is something that what happened when I just added the slide yesterday. You know, when I was listening to what was going on, and I think there are 4 things that come to mind, actually 3. But one, I think, are we looking at, are these advantages or not? So one, I think Africa is starting late. Many other countries have already launched pension schemes. Latin America led the way in the 80s in doing pension reforms. And then you have countries like India and other countries which have also embarked on informal sector pension cover. So I think to that extent, I think Africa is one of the latest entrants into thinking more seriously about this issue. But I think that's a huge advantage because we don't have to learn from our own mistakes and experiences. We have the ability, therefore, to learn from the experiences of other countries. To a certain extent, I think Africa is also starting early. And when I say early, I mean in the demographic transition. We are the youngest continent here. And I think to that extent, I think there are huge benefits. That means that almost everybody in Africa who we are trying to look at when we expand pension coverage has at least 30 years to go before she retires. And I think that's hugely valuable. That means that even with modest contributions, with compounding and some sensible investments, there is a good chance that a large part of Africa will be non-poor when they're old. But the challenges of being the youngest continent is also that how do you convince an 18-year-old in Uganda or a 21-year-old in Kenya to actually save for retirement? At that point, like Parul mentioned, retirement is too far away. And unfortunately, by the time you're my age, and you're shaving in the morning and you realize, till when am I going to work? And unfortunately, I've lost 30 years of compounding. So I think there is an advantage and a disadvantage here. But I see the glass as half full. These are some just statistics we've looked at yesterday. To a certain extent, one, of course, it's more than 90%, but a large part, clearly, of the workforce is outside of formal pension arrangements. The second, I think, is that if you look at the UN numbers, Africa is going to grow, the pace of the growth of the elderly, though we are the youngest continent, is going to be the fastest. We're going to grow at the rate of about 250% over the next 30 years. So by the time we are in 2050, we're going to end up with about 225 million elderly above the age of 60. So I think at that point in time, and we had this conversation yesterday about ESG, and I think there is a great similarity between pension exclusion and climate change. It's exactly that. So by the time we are in 2050 and we have 250 million elderly, and if we don't do something about it today, at that point in time, not only are we going to face an increased level of vulnerability, and we'll end up with 250 million people with zero savings, leading extremely difficult lives for about 20-25 years. But this is also going to impact everybody else. And it's going to impact because governments will not be able to stand aside and allow the elderly to starve. So there will be a need for governments to step forward with fiscal incentives or fiscal resources and with social pensions and so on and so forth. And that's going to impose burdens on taxpayers. That's going to be at the cost of other public investments on infrastructure, health, and and so on and so forth. So I think it's a big challenge, and I think we need to think about pensions somewhat like climate change, also in terms of scale. The third, I think, is if we don't do something about it, I think we are looking at a very large bill. We'll end up with, this is back of the envelope, but if 80-90% of these people are given a pension of even $2, which in 2050 may not be sufficient, but even if a $2 a day kind of a pension is given, you're looking at roughly $3 trillion of expenses that collectively the nations on this continent will have to bear over the lifetime of the poor, who are the future poor at that point in time. But the good thing is that we've seen the kind of returns that the continent has delivered on pension savings, and therefore, even if there was a person who, at the age of say between 20 and 25, started saving $1 a day, there is a good chance that that person will be able to accumulate enough savings by the time she's old, and therefore will be non-poor for the rest of her life. And this 500 is an inflation index number of a pension value. And if we get this right, then you're looking at a substantial part of the funding gap that we heard about yesterday on infrastructure and so on and so forth could actually get satisfied purely because of the kind of pension savings. Now this, I won't go into too much of detail, partly because there is too much here, and secondly, I'm not wearing my specs, so I can't read the numbers. But basically what we did was we said, okay, what if what if countries actually had to pay $1 a day of a pension to people who are going to be old, based on World Bank numbers and UN projections? If these people were old, what would happen to the governments concerned? And you can see on the right, that's the kind of numbers that we are seeing in millions of dollars. That's an annual number. So this is the kind of expenditure that countries will have to bear. And I see this as a cost of inaction, and I see this as a cost of delay. So if we don't get our act together today, that's what's staring at us 20, 30 years down the line. The flip side, of course, is that if we can motivate, if we can create mechanisms, products, communications, and systems that can encourage and enable the currently excluded workers to start saving for old age, I think there are very good positive outcomes as well. I mean, on the right-hand side, what you see is different countries and what could be the aggregate savings just if only 10% of the currently excluded informal sector workers on this continent started saving $1 a day. So clearly, I think it makes sense. We can't afford, frankly, we cannot afford the cost of failure. And I think the upside on succeeding with this are clearly there. Now, I mean, there are several cohorts which I think in this process require very special attention, and I think women clearly is one of those cohorts. We cannot, I don't think it's useful for us to think in a one-size-fits-all kind of a way when we think about pension policy design, systems, and so on and so forth, because women are actually quite unique. One, I think they need much more money when they're old, purely because of longevity. Women tend to live longer, therefore they will need to sustain themselves for a much longer period. And women in Africa are twice as likely as men to be living alone in their old age. And I think we therefore need to think of what to do when it comes to designing pension programs for women. The flip side is that while women need more money, for the reason on the right, they will actually not be able to accumulate the same amount of money. So if a man and a woman at 20 started setting aside 5% of their incomes for old age, the man is going to end up with much higher savings accumulations than the woman. And I think that's something we need to think about more. And I think the fact is also that women tend to be more informally employed. And I think there are serious constraints here. The good news, and anybody who works on micropensions and expects a Boda person to join a pension scheme at 18 and continue to save every day religiously till age 60 for a happy retirement has to be a die-hard optimist. So, and I'm one of those. So I see this seriously as a glass half full. When we look at what's happening in Africa, I think what has happened is that in the last 10 to 15 years, billions of dollars has been invested. And a lot of technical support has come in through institutions like UKAID or UNCDF, World Bank, African Development Bank, etc. And then you've got private foundations and guys like MasterCard and Visa and all of these guys putting in a lot of resources into building what I would call the digital financial inclusion infrastructure. So there's been a lot that's happened on payments. So currently, when I look at countries, what I see is in many countries, and I was talking to Olano yesterday, and I think many countries have already built the necessary, regulatory and legal frameworks required for expanding pension coverage. A lot of the countries today have, digital national IDs. Right here in Rwanda, it's one of the best, most efficient national IDs that I've seen. It's digital. And that's a key backbone infrastructure problem. Digital payments, again, I mean, what we've seen in Kenya and other countries, Tanzania now, for instance, it's fantastic. The kind of retail adoption on both digital IDs and payments is amazing. And payments is critical because, payments is the longest tenure of the relationship that I would have with my pension account. Because once I've opened my pension account, then for the next 30 years, I'm putting money in. And I need to have the ability to put it in month after month or day after day for that matter, without worrying about loss or theft or reconciliation errors and so on and so forth. And I need to be able to do this at a small transaction cost. And I think payments therefore is important. And when I receive my benefits back, again, critical. Digital IDs help you to create portable pension accounts, which then 30 years later, don't have to prove the ownership of. So 30 years later, I can just say, this is me, this is my biometrics, these benefits belong to me. So I think these are critical infrastructure pieces. They already exist in many countries. A lot of the countries already have well-regulated pension funds and insurance companies. We are seeing mass-scale, almost universal mobile penetration. A lot of people today have smartphones. And thanks to China, I mean, today we have many smartphones today are highly affordable. So you're seeing, and people are now using more data than voice. I mean, the people are just on social media and so on and so forth. And of course, we have millions of people who can save. Now, I won't say this is a problem or this is a solution for everybody, but I think there is this, the missing middle that somebody talked about yesterday. So there is this 50% of the informal sector workforce that can certainly, be considered as people who can afford to save. And finally, I think Africa is again very unique. You've built fantastic community networks. Right here in Rwanda, I've seen the power of SACCOs, I've seen the power of savings groups, and so on and so forth. And I think that's something that's an infrastructure that exists everywhere in most countries in Africa. So the challenge, of course, is that while this ecosystem exists, the reality also is that there is still no easy and simple way for people to save or to manage their risks. And these are some of the reasons. I mean, what really is preventing people today who are in the informal sector in a situation where, let's take Ejoheza for that matter. That scheme exists. Anybody in the country can use her mobile to open a pension account very easily. So what is stopping that from happening in Rwanda? Why don't we have universal coverage immediately? Why doesn't this happen in Kenya or Nigeria, which launched a national pension scheme, say, 3 years ago? Okay? And I think these are the main reasons. One, I think that the ecosystem exists. So you have national ID, you have payments, you have finance firms, you have banks, you have SACCOs, but all of them sort of exist in isolation. They don't sort of come together. So the ecosystem is fragmented. And I think it's possible, and we've seen that happening in India, we've seen that happening right here in Rwanda, and we've seen that happening in Kenya with what Sandeep is doing. That you're using technology then to integrate this ecosystem and instantly create a sort of a digital marketplace. It's like setting up like a Gmail system in a country, but only for pensions, where anybody should be able to then access that Gmail server to open a pension account, to get statements, get information, and so on and so forth, right? And it's completely portable. The second, I think, is on commercial viability. And I think this is an important issue because somehow when you talk to the traditional insurance companies or the traditional pension funds, they just don't, they depend heavily on agents for selling pensions, insurance, and financial services. Agents are remunerated, and the way the commercial incentives are structured, they're remunerated on the basis of the ticket sizes. And ticket sizes of most people in Africa, or in India for that matter, is likely to be very small. So therefore, it's not very attractive, it's not lucrative enough, and therefore agents are not beating down your door to say, please buy a pension from me, or please buy an insurance from me, unless you're sitting here in Kigali, or you're in, in Abuja or New Delhi. But in remote areas, there is no agent network. The second thing I think that we have seen is that, so in this case, I think it is possible, once you create a marketplace, to provide what I would call aggregators, provide SACCOs, employers, microfinance firms, banks, etc., access to this marketplace, and allow them to then, in turn, offer regulated pension products. And this, what you can then do is, you can start aggregating demand. So while, if I'm a pension fund, I don't have the ability or systems to go out and collect $1 per week from a Boda person in some village. But if you can do this for 1 million Bodas, and if you can aggregate this money and give me $1 million every week, I'm very happy to manage that money. If you can give me $500,000 of aggregated insurance premiums, and if I'm Prudential, I'm very happy to give you really low-cost insurance premiums. Okay? So aggregating demand is important. The third, I think, is friction. It's normally very, very complicated. And the reason we've seen, and I've seen this in India, trust me, we are one of the best countries when it comes to digital finance ecosystem. But it's easier to go and get a root canal from a dentist than to open a pension account. It's less painful to get a root canal. So I think, how can we make the process easy and simple? And I think, again, technology can help. I mean, so one of the things, and I'll show you what, say, Sandeep is doing here and what we're doing in India and a couple of other countries. How can we use or leverage platforms that people are comfortable with, and how can we make things easier and simpler and less cumbersome? And I think that will help to galvanize demand. The fourth is affordability. We keep hearing about the fact that, the poor don't really have money to save, but everybody saves. Okay? The problem, of course, is that they typically, most people end up saving, but they start, like during the pandemic, we went and met many people who were on the streets, walking back home to their villages, and we said, why are you leaving jobs and, occupations, and why are you going back home? Why are you on the roads in 30 days? Didn't you have enough money? Were you not saving? You were an Uber driver, you had a small shop somewhere, you were a street vendor. Why have you run out of money? And the problem, they said, was we save. The problem is every time there is a risk, if my child is unwell, my crop has failed, my cow has died, I've had an accident, in each of these situations, the only thing for us is that we use our savings to manage that risk. And they end up spending 100% of the cost of that risk. And when they don't have enough money to buy a cow from their own savings, they go out to a money lender and get an expensive emergency loan. Right? So what is ending up happening is that people then are using savings for risk management. They could have easily given a small premium to an insurance company and transferred the risk to an insurer and left. This would have released a large part of their savings. The second is, by taking an emergency loan for the balance amount, they have mortgaged future surplus income in favor of, repaying that loan. And if they didn't have that, they could have actually used that money to save. So I think one problem is people are not insured. And these are all insurable risks. So if we could add insurance as part of a pensions package, you will find that people will be able to save, and their savings will not get interrupted because of income interruptions, because those risks are covered by insurance. A second thing that we see is, which is again important, is that people don't have, in the informal sector, don't have a monthly income. People, if I'm an Uber driver or a street vendor, I'm earning every day. So if you ask me to save, say, $50 a month, based on my incomes in a month, aggregate incomes, I can save $50. But I never have $50 at one time. So can we do it easier? Can we tell an Uber driver, can you save $1 a day? Can you save $1.50 a day? And I'm 100%, I do this every time I'm in an Uber. That yes, sir, I can easily save $1 a day, $2 a day, no problem. If I drop $1, if I have 2 cups of tea, if I have a cigarette, the money just goes away. So that's hardly any money, and I can save that. So we can actually help people to create a retirement plan without actually creating a retirement plan. So they don't have to think hard. We are saying, can we therefore make savings more affordable? Both by adding insurance, and second, linking savings to income flows. If I'm a farmer, I earn thrice a year because of cropping cycles. Allow me to save thrice a year. Don't force me to save once a month. And the last is myopia. Unfortunately, retirement seems real only at my age for everybody. So how can we think about motivating people? And we heard about this yesterday, and I think it's a mix of things. Partly it's about literacy and financial education, and this is a really hard task. But the second, I think, which has worked in many countries I've seen, is the value of commercial incentives. And I think it's, fiscal incentives. And I think fiscal incentives for savings for retirement is good, because if you think about it, most countries, like Parul mentioned yesterday, most countries give tax breaks to the rich to achieve outcomes. So we're saying, if you're incurring, as a government, if you're incurring expenditure on account of foregone tax revenues for the rich, to motivate them to save for old age, why don't you do the same thing for the poor? And we've seen that happening with remarkable success. Rwanda has opened 1.5 million accounts over the last 3 years. So this is an architecture that's currently being used in India. It's being used by Rwanda. It's also being used in explain how this works. So there is a centralized platform. It's an admin platform, like the Ejoheza platform. On the back end, you have all the pieces of the ecosystem. Each of them gets connected to the platform through secure APIs. So what you're doing is you're actually using technology to... It works? Well, I don't know. Okay, so at the front end, what then happens is anybody can use any device from anywhere to set up a pension account within a couple of minutes. And when you have to make payments, you just simply use your whatever digital wallet you're using. You're using M-Pesa, you want to use Airtel Money, you want to use your bank account, you want to use a debit card. There are no restrictions. You save exactly in line with your incomes. And then you provide, banks, SACCOs, MFIs, and others, a plug-and-play access, free access to this marketplace. They, in turn, go out. So if I'm a SACCO and I'm dealing with 3,000 people in some villages, I'm only focused on educating those 3,000 people and cross-selling the idea of pensions to that cohort of. So you'll find, if you look at some of these firms, they will already exist. And between them, they will have millions of customers and clients and members and so on and so forth. So what we're saying is, let's not ask people to go and find new customers. Let's go to places where customers are already being aggregated. So you create a tech platform, integrate the ecosystem at the back end, provide a single window, easy, simple interface. And I'll give you an example of what I mean. So this is, for instance, how John in Kenya, so Zamara launched a pension program with, jointly with Prudential and Equity Bank. Zamara is the administrator in this case and the provider of the pension product. Prudential brings in insurance, M-Pesa brings in the payment side of it, and Equity Bank is involved in the distribution. This is a short video, it explains, so you'll see what happens when John wants to open. So what John simply does is, he saves Zamara's number on his WhatsApp as a contact. And then he just starts a conversation by saying hi. Okay? And this is a simple chat. This is how John would chat with his wife or his girlfriend or whoever. The second thing that is happening is that this platform that Zamara has built has actually been integrated at the back end with the national ID. So as a result, there is no data entry that has to be done. All the data is pulled in real time by pinging the national ID through a secure API integration. So let me just play this video. It's a 2-minute video, and this is exactly the time it takes for John to open a pension account. I want to open a pension account, so he types 1. So he says, John is my, she's my sister, Rose is my sister. So okay, now you will get, your account has been opened with Zamara. You'll get a 400 shillings collect request from M-Pesa on your M-Pesa ID. All you have to do is type in your M-Pesa PIN and the money will be debited. Type 1 to get the PIN, the M-Pesa PIN. He gets an M-Pesa PIN, he types in his ID, his PIN number, and his account is active. 400 shillings has been received, 100 shillings has gone to the administrator, to the distributor, which is Equity Bank in this case. 100 shillings has gone to Prudential, 200 shillings has gone to Zamara for the pension account. And this happened in exactly 1 minute, 59 seconds. Okay. So what I'm saying is, by the way, the good news is I'm almost through. I have only 3 slides left. The bad news is I could take another half an hour on 3 slides. So let's see how this goes. So what is happening here is that, and he's getting a real-time, this thing. Now, once you've set this up, then you can let your imagination go wild and say, okay, now I have this marketplace and a platform. How else can I use it? And please forgive me for people who've seen this before, but this is how, let's say, for instance, Zamara is offering domestic help, people like us, to set up a pension account for our domestic help, for our maids, cooks, nannies, drivers, security guards, and so on and so forth. This is a 2-minute video, so I can stop talking.
This is Rose. She is 24 years old. She lives in the countryside with her husband and 2 children. But her family is struggling to make ends meet. So Rose leaves home in search of work. You employ her as your nanny. She puts in long hours taking care of your home and children. She will send most of her income back home to feed her family and educate her children. They may have a better life than hers. She will do this year after year. When she's too old to work, she will return to her family home. Her children would have grown up and left home. Rose and her husband will now live alone. With no savings to fall back on, they will be unable to make ends meet and will live without dignity for the rest of their lives. It does not have to be this way. Let's see this again. You employ Rose as your nanny and talk to her about the importance of saving for her old age. You take just 5 minutes of your time to help her open. With your help, Rose will now begin to save regularly for her old age. When she is unable to work, she will return to her family home. She and her husband will still live alone, but with Rose's retirement savings, she will receive a monthly pension and will live with dignity for the rest of her life. This could be the story of your nanny, your watchman, your driver, or your gardener. Just 5 minutes of your time can change the rest of Rose's life. You can be the change. Gift Rose a Fahari retirement account with Zamara today. Her clock is already ticking.
Well, that's all applause for Sandeep. Sandeep, I hope you are listening and you're here. Okay, so 2 things. One, I think there needs to be much more dialogue and discussion. I think the stuff that Sandeep is doing is fantastic. I think the stuff that Mincofin and AFR have done and now being driven by BNR and RSSB is mind-blowing. I think along the way they've made mistakes. If I think about it, there are, I'm sure, deep concerns about adequacy of savings and you know, persistency of savings, even in a well-designed scheme like the Ejoheza. But equally, there are some fascinating examples. I mean, Ejoheza perhaps is the only scheme that allows me as a parent to open a pension account for an infant when that infant is born. I mean, that's mind-blowing, and that's really amazing. Imagine 18 years of additional compounding, you know. So I think there are some good lessons. So one of the things that Pinbox does is we facilitate more cooperation in this area, and we encourage more dialogue in this area. And one of the ways of doing so is to produce very heavy books on pensions. And so we've done the first one, which is here. I have a few copies. I have 2-3 copies. If anybody wants the book on the right, it's called Saving the Next Billion from Old Age Poverty. But this is a new book that we are now publishing, and I'm very happy to say that there are many very esteemed authors who've very graciously accepted to contribute to this book. It'll be in 3 broad categories. There are country case studies, there is infrastructure chapters on capital markets, insurance, national ID, and digital payments. And then there are some special cohorts which we think need special attention. Women, of course, but then equally, I think migrant workers is a large population. How do we think about pensions for migrants? How do we think about pensions for gig workers? Are they self-employed? Are they Uber employees? How should we think about this? Okay? And fourth is, of course, formal sector workers, people covered by the traditional NSSF, RSSB kind of programs. So what can be done to improve their outcomes going forward? And it's a great privilege that people like Dr. Farooq, Olano from South Africa, Martin from Uganda, Sandeep Raichura, Evans Osano from FSD, Eric Rigamba from Mincofin here, Jean-Boss Iachu from AFR, Hayford Krufi from Ghana, and some of these authors, and we have other authors who've agreed. We have people from the World Bank, from ILO, from UNCDF. So I think what we are hoping to do is, in February, we'll be hosting a meeting somewhat like this to release the book and create a forum by which we can have more dialogue. But this is the last slide. So basically what we are seeing is, with all the planning, with all the best laid plans, is this something that actually works? And this is a question that the Minicofin team had, or the government of Rwanda had, when we first designed this architecture. They were really, in two minds. Should they call the security and get us thrown out, or should they actually experiment with this mad idea? Thankfully, they didn't. The security was not available or whatever. But the main thing is that it seems to work. So this is just a short story. There was a woman called Saira Bano in a southern part of in India, in Karnataka. And we saw when she was putting money into her account, she was actually saving regularly. And not only that, she was actually inflation indexing her savings. And we had never really talked about inflation indexation. We had talked to her about the importance of saving regularly. So we went and met her. And we said that, okay, you had committed to save, a certain amount every year. And you are saving that certain amount every year. How do you manage it? This is fantastic. She says, Gautam bhai, what I do is I have a goat farm. Every year, I nominate one goat as my pension goat. When it is Eid, I go to the market and I sell that goat in the market. And whatever money I get from that goat, I put it into my pension account. I said, this is absolutely mind-blowing. We had never actually spoken about using goats to save for old age. And then we said, okay, but listen, hold on. Who told you about increasing your savings every year? She says, actually, I'm not doing that. That's all thanks to my goat. So how's that? Well, the goat sold for 3,000 rupees last year. This year it's selling for 3,700 rupees. The year after it'll sell for 4,500 bucks. So the inflation index is built into it. So my sense is, if we can make pensions, insurance, and savings easy and simple, and if we can do some of the things that I think we ought to do quickly, I think the way people will adopt and adapt to this idea and the concept of saving for old age will surprise us and will be counterintuitive. Thank you very much. All good things come to an end, and I appreciate your patience.
I'm back again. I'm not going to bother introducing Gautam at all now. He's just sapped into the rest of the conversation. So if you'd allow us, I'll take another 10 minutes of the existing time that we have. But great presentation, Gautam. Thank you. Without any delay, I would like to introduce the next panelists who are going to come on to talk about this very important issue of technology integration and what it means in today's day and time. Just a brief view on what this session will do. I think technology does and can do what we want it to do. But I think you need to think about what all avenues and pain points and understanding the people to make technology do and reach out to the people in their daily lives. The second part being that whatever I do, especially for youth, what we were talking about, and I was talking to, I've forgotten who I was saying this to yesterday. I have a millennial at home, and all they do is this, right? I mean, the other day there was a still photograph, and my son just did this to the still photograph because, you know, he's used. So I think getting into the regular DNA of these individuals to understand how to reach out to the youth, where are they using actually what they're doing, is very important. So without any delay, please, I'd like to introduce Mr. Nayanal Naganda Kurio. I hope I got that. And I'm going to try that again. Naganda Kurio. Did I get that right? No, he's still saying no. Lionel Naganda Kurio. Okay, I'm going to stop embarrassing myself. But he is the man of the hour because he's the one who is, please do, please. He is the ICT expert for the Rwanda Social Security Board. He is the one who is managing the hugely successful Ejoheza scheme, and he comes with great experience, and I'm sure he will share some of his the data and what is it taken for you to do the technology and sustain it. Next, I'd like to introduce Trisha Dulo. She's the manager from the Financial Services Commission, FSC in Mauritius. I met her for breakfast this morning. Please come, Trisha. And I was completely blown by the enthusiasm that she has on the pension side. She's an actuarial by study, has done banking systems and investment management, and now she works in the department. So welcome, Trisha. And I'd like to introduce last, and I promise I will give the least amount of questions to Gautam. Gautam Bharadwaj, my business partner in crime at Pinbox. The only thing I wanted to just take away from all of his session today, that when he was talking about the continent of Africa, he was saying we need to do something. So I think he belongs to this con. Right into the questions as soon as I find them on my phone. Sorry. Right, Lionel, I've got the first question for you. So many countries, including Uganda, Nigeria, have set up and you set up a central IT structure for scheme administration by RSSB, right? So it's a platform that is everybody can talk to, right? Based on your experience with administering the traditional RSSB scheme delivered through employers, what are the advantages of a central IT system? Clearly, they're different. And in the same question, I'm just going to platforms for IT that you have for the formal sector, and how is creating this, you know, what are the advantages of having RSSB also administering the IT platform for Ejoheza?
Thank you. It's a very interesting question, and actually it is really clear that when you explain, you compare the two Ejoheza scheme and the traditional RSSB pension scheme, they are actually very different because of the processes behind that. And Ejoheza physically. And imagine lockdowns around the countries, branches cannot serve everyone. And at the same time, you see that the paper introduces even more people they have like working hours, etc. That's a very interesting demo that our friend just did previously. And this is actually what we are trying to do and to move on for the RSB traditional scheme. But I would say that these paper-based processes, I would say these critical functions, it was seen actually that even our continuity plans to deliver amid any disaster or a catastrophe or the pandemic that was happening, we ended up seeing that actually the critical business functions were actually affected, which means that we need basically to rethink what we call even the continuity for the RSP traditional scheme. And I'm not even talking about the issue with storing paper. It's not even environmental friendly. It's not, you cannot even be data-driven when you depend on paper. And also on the efficiency side, I think it's also very clear that the number of staff that we have for pension is actually totally different from the number of staff that we have for Asia as a scheme. Thank you.
Thank you. I think I'm fairly sort of fascinated with the way Asia has been administered as well. And I'd like to talk about the data points, but I think I'll take the next question in the next round for you on that. But Gautam, I did want to come to you on a few questions, but I think this is one panel that is gender balanced. So I'm going to go to Trisha first. Trisha, I think just tell us a little about the pension system in Mauritius, because it is different from what we traditionally see otherwise. And I was absolutely amazed to know, and I didn't know, that nearly 95% of the population is formal sector workforce in Mauritius. I knew it somewhere at the back of my mind, but it kind of still hits me every time I hear that. And what do you think is the role of IT in strengthening the supervision and the enforcement?
Yes, thank you, Parul, for giving me the opportunity to address the audience today this morning. But before I touch upon the topic of digitalization from a regulatory perspective, I would like to give you a brief about the country's multi-pillar system so that you understand from a regulator's point of view where we are coming from. So Mauritius is a multi-pillar system, right? And yesterday we were discussing about that in one of the sessions. And we have the 0 pillar, we have the pillar 1, pillar 2, and pillar 3, right? And we as a regulator in Mauritius, we regulate the private sector occupational pension schemes. So basically, we have a tradition of insurance companies providing for contractual forms for group pension. And throughout the last 10 years, with the proclamation of the new law, the Private Pension Schemes Act, we have consolidated the fragmented framework of private pensions in Mauritius. And that's where our role as a regulator comes in since 2012, is to regulate those private sector occupational pension schemes. And as an integrated regulator, the Financial Services Commission of Mauritius regulates different sectors of activities: the global business, capital market, insurance and pension, international funds. Okay? So with regards to that, we have approximately over 22,000 licensees. So you can see where the solution of technology would come in. And based on this, I'll talk furthermore on your second round of questions. Thank you.
Thank you so much. Thank you so much, Trisha. I think the whole Mauritius system is unique. Even though the informal sector ones are changing, and hence the move towards the formal sector, and I think that is where IT playing a part for youth. I think I'll take up with that with you in the next session. Gautam, one of the things that you somewhat touched upon but didn't really explain quite explicitly, and I think that is also an important question for the audience that we have here, is how can IT help really strengthen the regulation and the governance? Because that is, at the end of the day, the IT would always fall back.
Centralized platform should generate system-driven, real-time data on what's happening all through the food chain, right from when subscribers are wanting to set up a pension account, when they start making contributions, when there is a complaint, when there is, if they're not saving regularly versus saving regularly, and so on and so forth. So I think what a centralized tech platform of the kind that Edjoheza has built, it does, and Lionel can correct me if I'm wrong, is that it can help you to create a dashboard and give you a single window view of what's happening in the system, and you're able to then instead of asking as a regulator, let's say, instead of BNR saying, please tell me that you have complied with A, B, C, D, E, a lot of the operational and field compliances are actually monitorable through real-time exception reports. So if you were supposed to collect some, collect some savings and transfer them, let's say if you are M-Pesa and you were supposed to transfer the money by end of day, and you've not transferred it by the end of day on the first day, it should immediately throw up a red light on the platform to say, okay, there is a 24-hour delay. So every time any intermediary goes beyond TAT, TAT is the turnaround time that has been specified by the regulator. And this could be 12 hours or 24 hours or a week. I mean, you could set the TAT as you want. So I think it helps you to monitor what's happening. And I think monitoring on the basis of exception reports is much more powerful, because you don't want to be really bothered about things that are moving well as a regulator. You really want to be bothered about things that are not going as prescribed. So I think a central tech platform gives you that ability. So when I talk to Eric, for instance, and I ask him a random question over a coffee saying, okay, Eric, so how many people have opened an account till now? He just looks at his phone and he gives me a precise number as of that date. By the time we finish our coffee, he can even update that number if more people have joined in any part of Rwanda. So I think these are some of the strengths that I see.
I'm going to actually pass that question to you as well, Lionel. So how is it, I believe you also have a helpline integrated into it, and there is the agent network that is integrated to it, in addition to the MIS platform that we see. So how is that advantageous, before I come to the second part, the question that I wanted to just share with you?
So if I understand well, I think what we are talking about here is that to be more, to give business intelligence to the policymakers and people who wants to do research and understand more the scheme. Because I believe that the behavior is somehow probably different from what you see in Nigeria and Ghana. And one of the key important factor is to be able to access and run analytics on what is actually happening. That's when actually you get more insights, and those insights can actually guide those who are working on regulations and understanding the financial market exactly.
Actually, that's a very important point, which feeds into what I was talking to, what even you mentioned today, was that the communication, right? So if there is enough data to figure out from the platforms like Ejoheza, so how is it that you can design communication better? What is it that you need to do differently to increase persistency? In which area are people more persistent or not persistent, or where are the agents which are performing better or not? So these are the things that will actually get to scale, which is important from the platform point of view. Before I come to you, Trisha, on how stakeholders and communities work, just one more question, Lionel. There is enough conversation yesterday, and I think it's also top of mind for you, to include the diaspora as a part of Ejoheza. How are you thinking about it and increasing access to them through digital platforms?
Thank you. I think that question of integrating, including the diaspora into the local Ejoheza, I would say it's also a challenge, because it's one of the key challenges is especially on the KYC. How do we actually verify that you are you? How do you actually prove that you are the person you are saying you are, especially if it is about money and savings, etc. However, we've enabled in a way that what we are designing now is we've enabled in a way that if I want to contribute for someone, I should be allowed. But if I want to onboard, for now, it's something that we are still redesigning with our embassies across the globe, because it's not something that is only affecting just locally here, but also the diaspora. So I think it's also part of the plan, and I would say that one of the key challenges was the KYC. Unless if we with the regulators, we all agreed that we could accept low KYC as a proper KYC for opening an account in Ejoheza. I think even in the demo example that he has shown on WhatsApp, I think that's exactly the same question. How actually do we prove that you are you? And in Rwanda, actually, we have already done even, we have even more data, for example. For instance, we are able to know that this phone number actually belongs to this NID. So basically, we are able actually to prove somehow that you are you, and you have the phone. Because it's all about authentication and strong authentication. Something you are, something you have, something you know. You know, something you know like a password. But we also need to know that how are you? Who are you, like exactly? So combining something you know and something you have, which is definitely your phone, and can also help in the KYC, which will be used for including diaspora. Thank you.
Thank you. Thank you.
Sorry, can I just clarify one point? So that's an interesting question around, data privacy or, knowing, am I who I am saying I am? And typically what we're seeing is a lot of digital IDs today have mobile numbers embedded. So when Gautam gets a mobile connection, then Gautam's mobile connection is verified by the national ID. So typically when a pension account is opened, let's say in India for that matter, on using WhatsApp, then the first process is that when I provide my national ID number, the national ID sends me an OTP on my registered mobile number to verify, and then I have to type in that OTP onto the WhatsApp platform. So then because it's about what I have, so it's a combination of what I have and what I know. So it then becomes a foolproof way of verifying identity.
And it's also possible to do a two-factor authentication if it's the diaspora. So you could send an OTP on email, and you can send one on the phone, and then you have a two-factor authentication. So that is something to be done. But I think one of the important questions that's coming up is on the behavior of the individual and how technology is matching during the difficult times through COVID pandemic and the Ukraine war. That brings me to the question for you, Trisha. So clearly, COVID has highlighted the importance of resilience and the need to ensure plans are in place to keep going. You have to keep going. Even in extreme circumstances, to ensure critical and essential services continue to be provided to the scheme members. Right now, to make sure this happens, trustees, trustee boards, stakeholders must consider their business continuity plans, right? And that is key to the success of any of these programs. But what exactly do they need to think about to build this resilience required to get through the period ahead, as we see after the pandemic?
Yes, thank you, Parul, for that very pertinent question in respect of the forum over the past 2 days now. The thing is, we have to see the sector as an interconnected system, right? Where technology is here to connect the different stakeholders of the private pensions industry. And how has COVID-19 impacted on the ongoing transformation of digitalization is that it has accelerated, right, the digitalization evolution. And in this respect, we have seen households, businesses, governments adapting to new technologies and finding ways of organizing themselves in order to mitigate health risks, right? And we have all experienced periods of lockdowns everywhere around the world. And that has made us resilient with regards to this crisis situation. And what has happened? Well, we can look at it from two different angles. We can touch upon it from the operator's angle. So what has helped during COVID-19 and what continues to help after COVID-19? Well, basically, we all know that service providers has developed mobile phone applications, allowing members of pension scheme to have 24/7 access to their pensions information, like membership details, calculation of projected retirement benefits, calculation of withdrawal benefits, their allocation of assets in different investment asset classes. So during the COVID time, members have still been in touch with their pension funds. And even after COVID time, it continues to be like this. So I think as different stakeholders of the pensions industry, we can rely ourselves on the evolution of technologies in order to get us ahead of situations. Now, looking at it from a regulatory perspective, during the COVID time again. So most of us have been working at home, and this has enabled us to be online at any point in time when it is required from our employers to be there. And what has helped us, I'll take the concrete example of FSC Mauritius, is that we have online applications, and this is known as the FSC One platform, and it is a platform that allows applicants to make their application online in order to get a license from the Commission. And they are allowed there to submit their relevant documents, etc., on the platform. And us, as officers of the Commission at home, we have access to that platform in order to assess, analyze the information submitted, and eventually come out with an approval for licenses. So basically, we can still continue to have lockdowns if necessary, but the work continues from both sides, both the applicant, both the regulator side. And also, we have the online data capture system that allows for the collection of data from our licensees through different surveys, etc., that we can access and assess. And I can tell you this definitely unburdens the licensees to a maximum, right? Mm-hmm. And it also makes it easy for us also as officers of the regulator to have access to those information and assess them accordingly. So from both perspectives, you can see that in the COVID time, the work has been continuing as per the relevant mandates of the stakeholders. So I guess COVID has been a learning point for all of us. And I think technology is there to help us to continue our journey, and because we don't know what's next, what's going to happen, and I think the availability of new technologies will definitely be a plus to all stakeholders, and thereby members also benefiting from it.
Thank you so much. I do have some comments on what both you and Lionel have said, but I'm just going to push in a question to Gautam before. Actually, sorry, Gautam, I'm going to make you wait and I'll ask her the question again. I think we have more questions online as well. Okay, sorry, I'm going to make it crisp. Clearly, one of the things that has come out is that during the pandemic, technology is the one that, in the case of the informal sector workforce through EJOHESA, that people were in touch with their schemes, and in the formal sector with in Mauritius, so it didn't matter. People were still able to continue to address their concerns. And I think, so this is just a comment, because then for any supervisor, any governor, any regulator, it then becomes imperative for you to have the access to...
or in India, where there is already, the scale is already very large, or even in Nigeria for that matter, where the scale is clearly very large, the government, as long as the legal, legislative and regulatory framework is in place, can actually leave things to the private sector to take this forward. The second role, I think, is the second and third are more places where public funds are going to be spent, and I think pensions requires the creation of public goods, and I think those public goods should be funded by the government. And those are two that I can think of, the critical ones. One is public awareness. It's very expensive for private institutions to create broad awareness of poverty among young people, and I think the government has a clear role to play. The problem with financial literacy is it's like clean air or like any other public good. So no private entity will have enough incentives or enough capital to create private goods. And I think government should step in and create broad-based awareness about the importance and urgency to save for old age. And the third is, I think, fiscal incentives. I mean, private institutions can't produce fiscal incentives or produce incentives more generally. So I think there is a role for the government to step forward, provide tax breaks to higher income people, and provide maybe co-contributions or subsidized insurances, etc., to people who are more vulnerable and not necessarily in the tax bracket. Thank you.
Thanks, Gautam. I think we can take a few questions which are online, and then I can direct them to, unless they're already addressed to the panelists.
Unfortunately, online, they haven't
Sure.
addressed exactly who should answer the question, but I'll read all the four, and then you can help us to assign the questions. Can you hear me, though?
Yes.
Okay. Right. So the first question is from Geraldine, and it goes, how do you deal with default payments / deductions? I'm not sure if it's on the Pinbox system, the Fahari, or on Asia Heza, but you'll help us to address that one. The second question is from Edwin. It says, considering the diversity of the informal sector workers, is it possible to have a single digital platform to effectively administer the scheme? And then the third question is from Edwin still. What is your experience in terms of the cost of integrating with mobile phone companies? And then the last question currently on board is, what is the panel's comments on dealing with data protection and security in a centralized system?
How to pay and make the deductions, I think, Lionel, you would be the most efficient in answering that. So how is it that, I think the question is around, I'm sorry, I can't read the question, but what I took of it is, how are payments and deductions done on a platform for informal sector workforce? Is that the question? Did I get that right?
It's mostly focused on default. How do you deal with default payments / deductions?
Thank you. Is it for the informal sector or for the formal sector?
I think you could try both.
For both, okay. So I believe that one key important thing about the schemes of pension is about to manage the contributions. For the formal sector, it is so far a mandatory schemes. The traditional RSSB scheme, the pension scheme, is a mandatory. And it's actually basically deducted from your payroll as an employer. So in Rwanda, you, as an employer, you have to basically to file declaration every month through the system. And then the system automatically deducts how much money you have to pay for the pension. And then you go and pay. So that is for the formal sector. And for the informal sector, I think one key point, it's a voluntary. It's a voluntary scheme, and therefore we need to rely on more effectiveness of mobilization and campaign awareness and sensitization to have more retirement literacy in the informal sector. At the same time, what we are also doing now is that in our SSP, through the IT modernization, we have redesigned the whole system. We have created a system called Next Generation Contribution Engine. Now this one will be collecting all the contributions which will be deducted from the payroll, but it will give more insight. It is even a modern system which will even help us in ensuring the compliance rate, because sometimes we discover that some employees, I would say, they want to apply for pension, and then they just discover that in 2006, my employer, who no longer exists, or the company no longer exists, had not paid for me, for example. So it's our mandate to actually ensure that the protection of the fund, of the contributions, and as it is mandatory, we need also to ensure that there is a full compliance rate by giving awareness to employees as of today, right? And we've developed platforms that we call Imisanzu, which means contribution in Kinyarwanda. We are still piloting it, but it's available at imisanzu.rssb.rw. And basically, you can have the full visibility, but the whole idea is to, if I come back on the informal sector, the whole idea is to, how do we actually incentivize someone to actually contribute? And it's through innovation, actually, through innovation. Azure has already a centralized IT platform, and we was also to include somehow like a monthly commitment, for example, and then also using technology to, send reminders, like reminding you of, you have committed for this, and I think that's what I can say on the people defaulting.
If I can just add to that, I think one of the beautiful things about the platform that EJOHESA has is while that it allows people to make ad hoc payments as well. So even if you're not meeting your monthly contribution, I believe the platform still allows you that if you've gathered a certain amount, you can give it, and if it's not on your monthly payment. Second, Gautam, I'll push it to you, is around, is diversity possible? Is it possible to have a single platform to deliver to the informal sector workforce? Diversity one, is it possible to have a single platform?
Yes, the short answer is yes. So the way it works, let's say in how it's working in India is that the same platform can be, you can do it in multiple ways. I as an individual can use WhatsApp to open my own pension account. There are 500 million people out there who are already using WhatsApp. So today, if we were to stand up and do this could be young people, old people, rich people, poor people, anybody with WhatsApp who wants to save for old age. The second is that there are already platforms which exist which are not necessarily pension platforms. So let's say the Uber platform or a delivery platform by Deliveroo or Food Panda or whatever. It is possible then to start embedding these platforms, the pension platform. So you can have an Uber app where there is a pension button on the Uber driver's app. He can click that button, he can set up a pension account with EJOHESA, he can put 50 cents or $1 a day right from his own app. So he doesn't even have to exit that Uber app or a delivery app or a supermarket app to be able to, or a payment company's app. So if you have a MasterCard app or some other app, you can actually do it from within that app. So this is an embedded model. And the third is an aggregation model for MSMEs. I always feel that MSMEs somehow end up falling through the cracks because the conversations on pensions are either about formal workers who are already covered and who have some NSSF, RSSB kind of arrangement, and the informal guys who don't have anything. But there is this clearly the MSME guys, and this is a very large sector. I'm sure in Nigeria, Dr. Farooq will agree, it's the number of micro enterprises would be humongous. Now, unfortunately, they're not informal, they're not salaried formal in that way. And they slip through the cracks partly because of compliance, monitoring and enforcement constraints of the pension administrators who are running these programs. So even if there's a mandatory program, smaller employers are able to fly under the radar. I've forgotten the question.
I know.
Yeah, sorry.
I know.
So,
Gautam, keep it crisp because we've and I have a question.
So I just wanted to say, so it is feasible then for micro employers to actually go onto this platform and say, I have 17 employees or I have 3 employees and I want to set up a pension account. You should be able to open a pension account seamlessly for all of them on that platform. So I think that a centralized platform it can be very nimble, and I think it can allow people with very diverse labor market attachments and income and occupational profiles to actually join that scheme. That's true for Gmail as well. It's the same principle.
Thanks, Gautam. Trisha, I think the question around data privacy is very important, and given that you work on a platform with 95% of the people on that, so how is data protection being addressed in your case?
Well, let me take it from the perspective that when you have innovative technologies, what happens in the sector? Mm-hmm. Well, it increases competition, right, among pensions providers to provide members with smarter choices and solutions. And with regards to that, we've seen that technologies have also enhanced communication, right? And for a regulator, that's very important. And also it enhances transparency and disclosure. And with regards to that, what becomes the concern? The concern becomes about data security and data privacy. So what happens is that even if we're not there yet, but we are getting there, and we also as regulators of the African continent, we are getting there. Well, we need to ensure on a robust cyber risk management framework, right? So why? Because we are aware that there has been an increased number of cyber crimes. So with regards to that, I think working together on this platform today and also internationally at the level of the IOPS, we should come out with best recommendations in order to provide us with insights to build up cyber security frameworks. So I think it is a work in progress.
Thank you. I think, do you want to add to that, Lionel, on the data protection at your end, considering you use digital IDs to open accounts, and there is enough history on that platform as well?
Thank you. I think in Rwanda there is the new data protection of the privacy law that requires that everyone should be complying by next year, October 2023. Mm-hmm. So as we are running through innovation and accelerating the digital transformation of RSSB and all the schemes, we are ensuring that we will be able to prove mathematically the transparency and the protection of the personal identifiable information for each of our members. Yeah, thank you.
Okay, thank you. Do we have any questions from the audience? Yes, Himanshi. Mm-hmm. Please do address it to the panelists if you could, please.
Sure.
Thank you.
I guess I'll give it to Gautam. So on the so you mentioned how enabling environment is so critical. ID, payment systems for trust, reducing the cost, making things easy. But in a lot of countries in Africa, coverage of ID systems are still low. Payment providers, it's a very fragmented market. Trust is still an issue. So in those contexts, would you recommend a checklist, or would you say if your country is not at this level, do not try this? Because we often have this issue where countries try at a nascent stage and they, because the systems are not in place, it's not a success, and then 20 years onwards, they do not want to engage on that dialogue ever again. So are there places where you say you're not ready yet for this kind of a scheme?
Thanks, Himanshi. That's a great question. Yes, there is a checklist, right? But it's not, so the way we would look at it is that you need a digital national ID to be able to deliver portable pension accounts. You do need digital payments because you want to make this easy and simple. If it's complicated, if I have to go to some office to make pension contributions, it's never going to happen, especially if it's voluntary. Right? So you need digital payments, you need a digital ID, you need some capital markets or some way that savings can actually be invested in a secure manner. You need well-regulated fund managers and insurance companies and all of that. The way we look at it, and I think when I say we, I mean die-hard optimists like me, is that the situation 1 year ago was very different. The situation 1 year later is going to be very different, and we are seeing a very fast adoption of technology across. So I was talking to ID for Africa, Joseph Attic, and Joseph was telling me, I was telling him you should do a chapter for this book, and which he's strongly recommended. Himanshi is the best person to do it. So then, but his view was, Gautam, it's so dynamic. Countries are making such rapid progress. So my sense is, any country, even Rwanda, I mean, we engaged in 2017, mid-2017, and finally the scheme was launched at a national level in December by His Excellency, the President here, in December 2018. So in that period, there was a period of, developing some of the other stuff, which is legislation and, framing the scheme rules, doing stakeholder consultations and so on. So this takes time. My sense is, countries like even Tanzania, for instance, they've leapfrogged in the way their national ID is being adopted, simply because they've said, okay, you want a mobile connection, get a national ID. You want to get your children to school, so I think you are seeing greater adoption. And as far as payments are concerned, trust me, the poor are the first to adapt to new technologies as long as they know it's cheaper, better, more secure. And we've seen that happening in India. During the pandemic, we added 200 million or so digital payment accounts in India just during the pandemic itself.
If I can just add one more point to this, sorry, probably I should not comment as a moderator, but Himanshi, I think one thing is also important is it's not that you can't start. Let's just slice and dice and understand what the customer wants and where the customer is. And it's possible to say, let's just start it for this occupation at this age in this area, or, you know, it's possible to do that. And then, I mean, because we're also battling with time is running out, right? Earlier you start. So why does it have to be starting at all in one go? Why can't we start it with people who have the capabilities on the building blocks and then take it to scale, as Gautam is saying, that rapidly it will happen? Sorry. Any other questions, please? Sorry, I know she's looking at me and saying, we're out of time and it's time for coffee. But I think with Gautam on the panel and Trisha as well, the landlines will be reserved. We could go on for another hour. Any other questions? I think that's it. If I could just sum up one thing from this conversation that I've seen, is what I started with, that technology is the backbone. It is the enabler. I think we're only limited by what we can make it do. But in all of this, matching the needs of the customer to do that demand side of each, especially for the informal sector workforce, is the backbone to making and designing the technology that there is. It does not probably make sense to have the informal sector workforce ride on legacy platforms, so they do require some supple platforms that will reach out to them in their daily lives. And reaching out to youth, women, let's not limit them that only if you have a smartphone can you do it. Rwanda does it on a USSD feature phone. It also does it on a web-based platform. Sandeep is also doing it on WhatsApp. They could be enabled SDKs into an Uber app. So I think access to the customer from everywhere, pretty much the way all of us have access to our schemes, is how it should be thought. Technology should be thought of for everybody in the informal sector workforce for mass scale adoption. Thank you very much. Thank you. Thank you, Gautam, Trisha, Lina. Thank you very much.
Thank you very much, dear panelists. And thank you very much, Parul, for leaving us on such a high note. I hope that Parul's conclusion stays on the mind of every single person who's thinking of technology, who's thinking about innovation. It has to be user-centered, really. Now, we are going for our first break of today, and I only have 2 announcements before we do that. So first, we have, as the agenda shows and as I announced yesterday, we are organizing a Kigali tour for international participants. A list is going to circulate when we come back for the next session. Please register if you're interested. It's going to be very helpful for the logistics. Number 2, for people who will be traveling back to their respective countries, please look at the travel requirements in terms of COVID restrictions. And if you need a COVID test, whether rapid test or PCR, we have our protocol team is going to help you get that. The cost of a PCR test is $40, and for a rapid test is $5, and that really depends on where you're traveling to. It's important that you look at the requirements for your respective countries. Thank you. Do enjoy your break, and let's meet again in 15 minutes. Hello once again. I hope we are enjoying our break. And this is the time that we come back to the room and continue with today's session. Protocol team, if you could please help us usher our participants inside the room again. We are getting close to the end of really the entire program. It's been very insightful, it's been thoughtful, and it has left us with a number of homeworks, and I'm very excited to come back to the next forum with some updates and probably new products that carry forward our pension sector. The next two sessions that will actually lead to the end of the conference, the first one is about pension adequacy and possible security challenges and disruptions. And that session is going to be led by Mr. Cosmas Senyonga from the Uganda Retirement Benefits Regulatory Authority. It's going to be followed by a panel discussion that is led by Mrs. Mayinza Masole, Prudential Supervision Manager at the Pensions and Insurance Authority of Zambia. So please, let's welcome Mr. Cosmas Senyonga. You're welcome on stage.
Good morning, ladies and gentlemen. Today, I learned a lot of things, and those include using goats as pensioner funding arrangements. Probably for us who are still working and we have farms, we can go and sell off some of the goats, and we enhance the adequacy of our benefits. Women are living longer, they need more savings. I think we as husbands, we need to do something about that. Should we earmark part of our salary to contribute towards our partner's retirement saving? Yeah, that's interesting, and I think we can have further discussion with Gautam on that. But since yesterday, a lot has been mentioned on adequacy and security. We've been able to look at the impact of COVID. There was a mention about how people are contributing. We had something on investment. All that contributes to adequacy. But look, the overall objective or the overall goal of any pension system is to ensure that there is that alleviation of old age poverty. So how do we do it? We need to ensure that these, our members make adequate contribution, or there is adequate funding into their pot such that that risk is alleviated. It is basically to ensure that they do maintain a decent standard of living. At the same time, of course, you can't talk about adequacy without looking at the security of these funds, which now speaks to the role of the regulator, the role of the policymakers. Then you have to look at the linkages in the systems. And those linkages, I think, should be addressed by not only the supervisors of these pension schemes, but the policy makers too. Okay, I want us to look at some of the statistics. There is one common metric for measuring adequacy, and that's the replacement ratio. I was discussing with somebody, and he was telling me, well, the benchmark is 70%, according to whether OECD or what. But that's the benchmark. But look what's happening. Some of the, I don't know if it's clear, but you can see that most of the countries are below 70%. And this study was, the simulation was done by the World Bank. They were looking at the national schemes vis-a-vis the civil service schemes. And you could see that there are some countries where the rates are good, others the rates are a bit down. When you look at Seychelles, Zambia, Zimbabwe, and you compare them with countries like, I see Madagascar, so you could see that a lot has to be done such that we can improve on the metric. But I want to share with you what's happening in Uganda. We have around 2.1 million contributors. That's around 10% in terms of the coverage. But when you look at the average balances on these for the sector, you could see that for the male, around 1,700 USD. Then for the female, it's around 2,000. So that speaks to what we have to do in order to enhance the replacement ratio and the adequacy of the pensions in our countries. So replacement rates below 40%. That's quite low compared to the benchmark of 70. And another surprising or another worrying indicator is when you look at our sector with the 5.5 billion USD, 80% of that belongs to 10% of the members. So meaning the 20% belongs to the 90%. That speaks to adequacy and why we need to raise up as key stakeholders to do something about the adequacy level to ensure that members have a decent standard of living. So why should we be concerned? Let's look at the demographics. Rising life expectancy. In all countries across the region, you could see that the life expectancy is increasing, not only at birth, but also at retirement. On average, across Africa, it is 17%. So if you retire today, you expect to live at the minimum 17 years. The question is, have you accumulated enough funds to take care of yourself? The question is, what are you doing as a regulator to enable these members at least to accumulate enough benefits? Lower ages at retirement. Let's reflect and look at what's in our legal frameworks back home. In Uganda, 50% you can access your benefits for the national pension system. Then for the civil servants, that's at 60%. But look, we are saying that when you retire at 60, you're going to live at the minimum another 17 years. And your eligibility criteria is speaking to 50 years. We need to do something. Are we going to increase the retirement age? Are we going to look at other key parameters which will enable us to accumulate more saving? Then the health care. All of us, we have grants. I can speak to that. When you reach retirement, you're likely to spend over 60% of your income into health and medical care. And I think that speaks to what Gautam talked about, what we learned yesterday about trying to incorporate some of these life products, the medical products, for our members, such that we can reduce on the risk related to the health. Then maybe there will be enough funds to take care of other things. When you look at the salaries, still from the sampled countries, you can see that South Africa, on average, somebody is earning around 2,200 USD. Then you have countries like Sudan and Ethiopia, which are below 100. What does that mean in terms of the accumulation of benefits? We've been talking about contribution rates. Somebody is contributing 10% or 15% of 80 USD on the monthly basis. Will that person be able to have a 70% replacement ratio at retirement? So in addition to that, we can look at the labor dynamics in the region. People having one-year contracts. And after that, what happened? The person is unemployed. he cannot make any contribution. Beyond that, we can look at what happened during COVID. People lost employment, and they were not able to make any saving. And in my country, I think when it came to the informal sector arrangement, the personal pension scheme, we saw a lot of a reduction in the contribution rates from the member. And we've also started seeing it now because the inflation rates are increasing across the region. So for the informal sector, people, they are more into ensuring that they have the basic needs. They are able to pay for the basic needs, school fees, and so on. So you cannot go to them now and start talking about contributing towards retirement when there is other pressing needs. Of course, the dependency ratio, which is around, I think, 6 now for Africa. So, and it's increasing. We need to be concerned as government and even the society, because at the end of the day, me who is accumulating saving, I'm the one to take care of those people. The government will have to incur a lot of expenditure towards providing social protection for such people. So those should be taken into consideration, especially when we are looking at the adequacy of the retirement income. But what are the challenges? This can be economic, legal, and governance. And the economic, I've mentioned inflation, how it has affected our sector, or how it is affecting. But these are the issues of monetary policies. During COVID, we saw a number of monetary policy responses from the central banks. In Uganda, it included stopping listed banks to declare dividend. So schemes which had invested into banks, they suffered. They didn't earn any return that year. So such kind of policies also have an impact on the accumulation of the members' funds. And of course, we've had a presentation on investment, and we need to ensure that our financial markets are developed, because there is no way how we can preserve these funds from inflation if the financial markets are not developed. We need to ensure that we work with there's a coordination between all the financial sector players, the CMAs, the policyholders, and see how best we can develop our capital markets. And also the competing government priorities. This is interesting. It's a bit political, but this is what's happening. Maybe where I'm coming from. My boss is here, and I think he will allow me to go back on the same plane. But because of the competing priorities, you find that the government is prioritizing maybe infrastructure. And what they are looking at is how can we raise revenue, domestic revenue. Then they go back and say, okay, let's increase the tax base. And that tax base, there is a possibility that they are going to introduce a tax which will hinder accumulation of benefits, probably on tax, on income, depending on the tax regime which applies in that country. But the legal framework pension system design is very critical. We have some countries where it is dominated by Provident Fund. I can speak for my country. Our National Social Security Fund, which is the biggest fund in Uganda, pays out lump sum. And the research which they conducted some time back indicated that within 2 years, somebody who has been paid 200 million Uganda shillings, he has already lost it. What does that mean when we are looking at the adequacy? Somebody who's going to live for more than 17 years in retirement. And surprisingly, do you know what they are doing for the men? He could go to campus and pick out a cute babe. I mean, getting another wife. So somebody has been saving for over 30 years to get a second or third wife. When I see a new Benz in town, especially after the declaration of interest in Uganda, I start thinking about the monies which NSSF has just paid between October and December. there is a likelihood that it has funded the Benz or the limousine around. So pension design are very critical. We need to think through them. Then the powers of the sector regulators, the issue of security here comes in. If you're a regulator and you cannot sanction, if you're a regulator and you cannot conduct investigation, then you need to rethink your legal framework. Because there is no way how you ensure security of the members' benefit if you cannot have the powers to put order in the sector. So issues related to the indexation, especially to the arrangements where pensions are paid. We had a discussion some time back when we are looking at pensions paid by the civil service scheme. There is a likelihood that some people who used to get 10,000 Uganda shillings around 1990, they are still getting the same amount. But inflation has been rising. And what's the purchasing power of the 10,000 today? So we need to think through that, and also portability of the accumulated benefits. Do you allow members, if you exit from one employer to another, to transfer from one scheme to another? In Uganda, there is, when you look at the NSSF Act, if I've been in private sector or in a government parastatal, I have to save in NSSF. But if I join civil service, I cannot put what I've accumulated into the other arrangement. I get my lump sum and I enjoy. Then governance management. Governance and management, this is very critical from yesterday's presentation. Issues related to governance. These are the decision makers. They will say that let the money be invested this side. They can also decide to take a trip in Dubai using members' funds. Issues of conflict, fraud, and corruption, they are very, very, very relevant when we are looking at the governance. So as a regulator, we need to put in place a legal framework which has some kind of controls in terms of the management and governance of these funds. And of course, competence. We had that a number of countries, they have tried to come up with a trustee development program. So through that kind of training, you're able to equip these boards of trustees to understand their fiduciary responsibility and how best they can manage members' funds. High level fragmentation. We do have countries where we have more than 1,000 retirement benefit schemes. For us, we are lucky, they are around 65, but we are looking at how best we can consolidate. Does it make sense for somebody to operate a scheme which is a 1 billion Uganda shillings when there are umbrella schemes which have been licensed and they can join and they benefit from economies of scale? So we need to think through all that. Do we need to have some kind of consolidation? Do we need to have some limits in terms of the fund values and establishing this kind of arrangement? Political interference. This is mostly in a government-related pension scheme, the National Social Security Funds, where the government can interfere, especially when it comes to investment. The government can decide that we need to build government offices, and they are targeting to use members' funds. The question is, what are the risks if you're the board of trustees on the other side, and even the regulator? Have you tried to advise? Of course, advising is always very difficult, especially when it's coming, when it's a political interference. So the disclosures are also very critical, because with the disclosures, you're able to tell members that this is the performance. This is the performance of the scheme. This is how we are spending your money. And that can build trust and confidence, which may create more avenues for more contribution into the fund. We heard yesterday about the addition of voluntary contributions. And before we introduced a regulation on financial reporting and disclosure requirement, we did growing over the years. Maybe because of the disclosures, people know that if I put money into a pension fund, I'm able to make a return of this. This is how the scheme is being operated, and this is the expenditures which likely to eat up my money. But we can look at the opportunities. The demographic dividend came out yesterday. But I think we should look beyond this. Yes, the population is young, but have we put in place strategies or mechanisms which can enable these people to contribute? Yeah? The needs, are the solutions we have in place, are they suitable for their needs such that they can come on board? So we need to think through that. But the good thing, the population is young and the legal framework is there, then we need to put, to understand their needs and also see how best we can bring them on board. Of course, growing economies, it comes with industrialization and probably job creations. So we expect more people to be employed. And of course, that can also speak to, industrialization can also speak to the increase in the wages and so on, which contributes to the adequacy at the same time. I don't have to go through this. I think Gotham did a lot about the old age. But Africa, you have the smallest population when it comes to the old age. Robust legal and supervisory framework, I talked about it. You need to ensure that you have that in place. Innovation, it has come out, not only to the informal sector, but even to the formal sector. We need to have a lot of innovation. Fintechs are very critical. We've seen a number of products coming up in my countries which are targeting not only the informal sector, but also these other people in the formal sector, whereby they are telling them you can contribute your AVC and your AVC can go towards this kind of arrangement. And of course, for the supervisors, I heard about the risk-based supervision. You can leverage on technology to improve on your supervision through the risk-based approach. Donor support, of course, Access for Africa, the IMF, all these, the FSD, you've been able to provide funding. And these fundings can be directed towards improving the adequacy, improving securities, whereby you're enhancing the capabilities of the supervisory framework, you're funding probably the IT platforms to enable the informal sector workers come on board. And of course, we have a lot of association or financial sector associations. The APSA, today we are here, we are deliberating on our pressing issues. So from this kind of arrangement, we can draw a lot of lessons, and when we go back, we are able to improve on our supervisory frameworks, which can also speak to the security and the adequacy. What are the way forward? I've talked about this, I think. But for the policymaker, I have a role to play. But I want to go into some penalties for early withdrawal and lump sum payment, where members accessing their money before retirement, you can introduce a penalty there, and it can be in terms of taxes. Say if you want to access up to this much, 30% into maybe a midterm access, you're going to pay this much. But if you leave your money there till retirement, then either the tax rate will reduce or you can go without even paying taxes. So you can use such kind of mechanism, introducing mandatory annuity products, and I think this is something which we are trying to introduce in Uganda, such that people don't go with the lump sum payments, the development of the financial markets, and so on. And for the supervisors, technology is very critical, because that's the way to go. Technology is with us, and it has been to change the financial systems. So we need to leverage on that, either to improve on our supervisory frameworks. We can leverage on that to promote some kind of products which are very suitable for our people. Disclosure of fees, structures, plans, and performance is also good, because it builds trust, and it is good for the individual and even the informal sector. Allowing for portability, we need to look at the legal frameworks and try to make some amendments whereby pension schemes can transfer their accrued benefits, or the members can transfer their accrued benefits from one entity to another. It can even be across the region. At the ESC level, we are coming up with a portability bill, whereby if you're in Uganda and you're a Kenyan, when you're going back home, you can transfer the accrued benefits back to Kenya, the ones which you've saved in Uganda. Regulating pension investment options. We've had a lot on investment. Do we need to open up our economies and say, you can go and invest beyond East Africa, probably South Africa? Because at the end of the day, you're looking for a return to enhance the adequacy of your members' retirement income. So do we need to go into, it was the private debt. In Uganda, we provide up to 30%, but when you look at the uptake, it is very small, which may also speaks to the suppliers of these products. And I think the guaranteeing and the awareness is very critical to enhance the uptake of those either private equity or debt. Introduction of a flexible, cost-effective micro-pension. I shouldn't waste a lot of time on this. But lastly is continuous retirement planning, not only to the supervisor, but even to the boards of trustees. Yeah, we need to try and conduct this kind of trainings to enable members appreciate the need and why they need to save and have enough funds to take care of them in retirement. Thank you very much. That has been my presentation. Back to Ingrid.
Okay. Thank you very much, Cosmas, for that presentation. And we are going to quickly go into the panel discussion where we'll look at the matters that he has highlighted on adequacy and security. And of course, as a forum of supervisors, I believe the issue of security is something that we are familiar with. So we'll delve a little more into adequacy and unpack some of those insights that Cosmas has covered. So we are welcoming our panel discussants, Mr. Sandeep Rachura, Group Executive of CEO Zamara. Then we also have Mr. Siongo Kisoso, Head of Investment Banking and Capital Markets from BK Capital. And of course, joining the the panel is also Mr. Cosmas Senyongo from Uganda Retirement Benefit Authority, who assisted us with the presentation. Welcome, panelists. Yeah, so we have a little over 15 minutes to delve into the discussion around adequacy in pensions. So I'll just go right into it. And perhaps I'll start with you, Sandeep, just to explain to us how contribution rates and life expectancy contribute to pension adequacy in the pension system design. And perhaps as you do that, you can also touch a little on a definition of adequacy. I know he covered the metric, but perhaps just to share some experience in that area from your background. Thank you.
Okay, thank you very much, Manzi. I believe Cosmos covered the subject very well. His presentation was excellent. I really liked, Cosmos, how you brought out the life expectancy post-retirement, because yesterday when the Deputy Governor spoke, he talked about life expectancy in Africa improving from 46 to, I believe, 64 years. And that is life expectancy at birth, which is very heavily impacted by infant mortality, the accident mortality between the ages of 25 and 30. And, you know, the biggest challenge that we have in Africa talking about pensions is a lot of people say, well, you know, we're never even going to get there. And if that were the case, you know, a lot of us in this room would be approaching that time or be living on borrowed time. So life expectancy at birth in Africa, after you've crossed 35, is probably no different to what it is in the rest of the world. I'm certainly planning on living to 100, and I believe everybody in the room should be looking to do the same. So ensuring that our pension systems can deliver a benefit for a life that could be as long as the period we are working is extremely critical. So let us look at adequacy a bit more deeper. So I would look at adequacy possibly from 3 different perspectives. The first is the level and the form in which benefits are provided under a pension system. Secondly, adequacy when measured in terms of the proportion of the population that is covered. And again, this second point we have debated at length in Africa, where you've got huge informal sector populations, 80% of the workforce in the informal sector, and there needs to be interventions around there, whether through micro pensions or others, and we've discussed that exhaustively. And thirdly, to look at adequacy in the reverse way, because I see in Africa situations where there is a disproportionate level of resources devoted to a small segment of the population. And again, there needs to be some fairness and equity in terms of how a pension system works. So let me just look at the first point a bit more. And Cosmo shared the statistics about the levels of adequacy of benefits, average about 40%, if I heard you right, Cosmos. In Kenya, our figures are even lower at about 30 to 34%. And we have a huge challenge that most of the benefits are provided in the form of a lump sum. So therefore, in Kenya, our experience shows that within 3 years that money is squandered, is lost. But you mentioned that it could happen in one night in Uganda. Interesting, but yeah, and that's the realities that we have on the ground of benefits that are paid in the form of a lump sum. So I believe the area of ensuring that there is an adequate level of contributions. So for whether it's a mandatory system like in Uganda or the likes of Tanzania or Nigeria, or whether it's a voluntary system like in Kenya and South Africa, I believe there is a need to have legislation on minimum levels of contributions, as well as the requirements to ensure greater proportions of benefits are preserved, because one big reason why we have low replacement rates is the extent to which people access their money when they exit employment. So those are two key areas that I would focus on, and also ensuring a level of annuitization, that benefits are paid in the form of a regular income. Let's look at the third point a bit more, if we may, Manzi. Sorry to take more time. Is that there are pension schemes in Africa, particularly public sector schemes, which many of which are not fully funded, which consume a lot of public resources, and I believe that there needs to be reform of those systems, because there are pension systems which promise the earth. There's political expediency which results in higher benefits being promised, but then you're not worried because you only have a short-term horizon. You're not worried about who's going to pay for those costs. So I think looking at the sustainability of some of the public sector schemes in Africa is important. And I'm really happy Mrs. Mugo is here from Kenya. When she was at our National Treasury, she actually took the bull by the horns and undertook and sort of forced a dramatic reform of Kenya's public sector schemes, which were heavily underfunded and which promised benefits that could not be afforded. Sorry to spend a bit longer.
Thank you very much for that very comprehensive response in terms of the issues that have to be considered under life expectancy. Cosmas, you took us through the challenges and some of the disruptions in terms of achieving pension adequacy. Are you able to actually give us more insights in terms of how this can be mitigated and pension schemes can work towards overcoming these challenges?
Thank you. I think some of them have been mentioned by Sadip. Sadip, right? Okay. Things related to the legal framework. If you're really allowing for lump sum, then there is no way how you can achieve what we are looking at as the 70% replacement rate. We need to bridge or to cross some of those linkages within our systems to ensure that we achieve our overall objective of ensuring the decent standard of living. Then the issue of taxation, when you look at across the region, in Uganda we have a TTE. You pay tax on contribution, you pay tax on investment. What does that mean to the contributors? Some other countries, they have adopted a different regime, especially when you look at here, it is, I think, a TEE. So there's the exemption at the beginning. In some other countries, the taxation is in the middle. I think what we need to do is to find out what's the appropriate regime for our people, such that they can accumulate enough funds for their retirement.
Mr. Siongo, do you wish to add anything to that?
Thank you.
Good afternoon, everyone. A lot has been said today, yesterday as well, in terms of what can be done to better design, better structure pension systems. So mine will just be a reflection on some additional points that my fellow panelists haven't raised. There's a saying that I had some time back, I don't know where it's from, but they say to know where you're going, you should ask those who've come back. We've shared a lot about the opportunities, the successes, the challenges of different pension systems. So if I can just give a few points from a private sector perspective, I think in terms of design, something that came out yesterday is that here in Africa, they're competing needs for the few financial resources that a number of the population have. So as policymakers and practitioners think about developing pension systems that can attract the informal sector, I think having blended schemes is something that should be looked at. For this, I think there would need to be some flexibility on the rules. So in terms of blended schemes, they're the traditional pension schemes where you have a pool of long-term savings, but there are developments from Nigeria, for example, in South Africa, where there's a pot that's accessible for short to medium-term needs. And I think having this sort of blended pension schemes could attract a lot more of the informal sector. I'd say that's one. In terms of micro pension, it's been around for a while. I started working in the late 2000s. I think that can tell you how old I am. And at that time, micro pension in Kenya emerged, and I think it hasn't gained the traction that a lot expected. And looking at some of the successes of Ejoheza, looking at some of the initial success of Equity Bank and Zamara, one thing comes out that some of the solutions that should be designed for the informal sector, particularly the missing middle, need to be backed by very strong sponsors that have wide distribution networks, sponsors with deep capital, and this can help overcome some of the challenges of reaching out to the missing middle, which are high acquisition and high distribution costs. Something that hasn't been mentioned too much, but has been touched on, that was touched on earlier on, is investment returns. We talk a lot about the gross return, and a lot of opportunities have been highlighted today and yesterday. There's private debt, there's infrastructure financing, but one that isn't talked about. A lot of sponsors, over the years have developed in terms of governance, in terms of being able to achieve above inflation returns, but the efficiency through which these returns are delivered, I think there is a bit of improvement there. There are some state-sponsored schemes that have efficiency ratios, not efficiency ratios, but have expense ratios of 3 to 5%, and this really takes away from the net returns. So there is room to really look at how these schemes are managed to reduce the expense ratio, which in turn will mean better pension adequacy for everyone. And I think the last thing I'll touch on is on financial literacy. I'm sure all of us here as pension practitioners, whether regulators, private sector practitioners, etc., have a family member who they've told about pension and don't have a pension scheme. So I think that really highlights the challenge of financial literacy, and a lot has to be invested in getting the young, and not just the young, just the general population.
On the key issues that we should be considering even as we look at adequacy of pension schemes, perhaps in the interest of time, I can allow just for one question, if there is any question. Perhaps we could be assisted with a mic.
Thank you. It's not so much a question and observation. I mean, I think if you're looking at I think one is a preservation question, and the second is the longevity risk, right? I mean, we are saying, how can people accumulate optimum savings and then not spend them in the first 3 years of their retirement, right? And I think tax perhaps could be one vehicle for at least the populations which are already in the tax bracket. Annuities, we are seeing in developing countries, is not necessarily the best option. It's normally the best option from a longevity risk point of view, but the problem is the way annuities get priced. Insurance companies are very conservative in the way they price annuities, and they typically use mortality tables or experiences of the insured population, which is normally higher income people. So I think instead of annuities, if we can think of phase withdrawals, well-structured phase withdrawals, and if we can think of, the tax treatment to be, instead of TTE, if we could flip this and into an EET, and that's something that, let's say, India has done quite successfully, what it does is it sort of encourages contributions at the front end, doesn't take away the money while you're earning the returns over your lifetime, and that compounding is very important. And then allow people to withdraw whatever they want. However, the withdrawals in a particular year of whatever pension they are withdrawing, that gets added to their nominal income, to their income for the year, and is taxed at the nominal rate. So therefore, if I've got, say, $100,000, I could withdraw $100,000 if I want, but they'll have to pay a 30% tax on that. If there is a minimum ceiling of, say, free, tax-free income of 5,000, then I will automatically try and stay within that level and smoothen my consumption and start drawing only 5,000 a year to avoid paying taxes. So it's sort of, without wielding a stick from a mandate perspective, you sort of prompt better exit behavior, if I may say so, and perhaps help smoothen consumption over a period of time.
Thank you for that comment. I don't know, Ingrid, are we able to take one more?
This is a comment on which I'd like a reaction from any of the panelists or all. But you showed the retirement age numbers, and those are very high. And oftentimes when we're talking to social security institutions and policymakers for reform, retirement age ends up being one of those things where we at least increase it in line with life expectancy, and retirement ages across Africa are still much lower. But the challenge we often hear is that if you increase retirement age, the focus has never been on lifelong learning. So people at that 50, 55 years, there's a lot of pushback, social pushback, when you start increasing, having a conversation increasing retirement age. How important a role it is, in your view, for pension systems to start thinking about extending working lives? And it's not necessarily a social security role, it's a policy role, but do you think it's going to be challenging unless we start focusing on extending working lives, reforms in Africa?
Sandeep, are you able to take that?
Yeah, Manshi, that's a good question, because a lot of the systems that we now see in Africa are defined contribution. The impact on the pension systems of having, of the retirement age is not as much as it is in the West, right? In terms of, the period of time the benefit needs to be paid for. So it's not as big an issue as it is in the West. And in fact, in Kenya, for example, a few years back, we increased our retirement age from 55 to 60, precisely to delay the pension payments for the civil service. There was a proposal last year to increase it from 60 to 65, but that was heavily shot down because it was felt that it would deprive the younger workforce of jobs, which I think is a misleading argument, but those are the policy challenges that are faced on the ground. So it's not as big an issue as it is in the Western world. So there isn't the pressure to increase retirement ages to meet your pension liabilities as it is in the West.
Thank you very much. And just in the interest of time, I believe we have come to the end of our panel discussion on adequacy and security, and I hope you've learned one or two things that we can be able to take and implement as we go home. Thank you.
Thank you very much, dear panelists. And thank you very much for an amazing moderation and right on point in terms of time. I believe that we have noticed that we are currently physically with our Deputy Governor, the Deputy Governor of the National Bank of Rwanda. And I stress on physically because I'm sure that she has been following and engaging us on all the different live streams that we have. So please, let's take this time and welcome her to hear her remarks for today. Welcome, Deputy Governor.
Thank you very much, Ingrid. Vice Chair of the APSF Interim Committee, CEOs and representative of African Pensions Supervisory Authorities in Africa, senior government officials and development partners, ladies and gentlemen, good afternoon. It is really a pleasure and an honor to address you today. And first, I will have to apologize because I've had to change my schedule a bit to attend another meeting after this forum, but I thought it was important to still be here as we're coming to the last day of our Africa Pensions Supervisors Forum conference to be able to address you and draw some conclusions, although I know we still have another session coming. But we do so far appreciate the high quality of discussions and deliberations throughout these 2 days. And let me start by acknowledging and expressing my sincere gratitude to the African Pensions Supervisors Forum Interim Committee, the team at the National Bank of Rwanda for their tireless efforts in ensuring that this event was a success. Please join me in a round of applause for the organizing team. Our warm appreciation also goes to FSD Africa and Access to Finance Rwanda for their unwavering support in the preparation of this conference and the existing valuable partnerships that we have with both organizations. To the speakers, moderators, panelists, and participants, we can't thank you enough. This conference would not have been a success without the insights, knowledge, and experiences that we shared during the different sessions. The conference theme wouldn't have come at a better time: resilience and sustainability of the pension sector amid crisis. As we all know, the world and our continent in particular is still grappling with the impact of the COVID-19 pandemic, as well as external shocks and inflationary pressures that were exacerbated by the Ukraine-Russia war. The different discussions and deliberations that we have had during these 2 days have explicitly shown how the pension sector, like any other sector, was affected by the pandemic, but also the socioeconomic impact on our citizens and our livelihoods. In particular, the loss of jobs and instability in employment during this period, the premature surrenders and benefits claims increased, while shocks on asset prices heightened. This obviously negatively impacted the balance sheet of pension schemes across Africa. Their solvency were threatened and funding of defined pension schemes decreased. But despite all these challenges, it is good to know that the pension sector continues to be resilient, thanks to a number of regulatory and effective supervisory measures that were put in place to ensure their sustainability. Indeed, as the crucial role of pensions, not only for beneficiaries, but also for our country's socio-economic development, cannot be overstated. I will not repeat what my colleagues have touched upon on the need to substantially increase long-term savings, but also ensure that the largest part of our population have access to viable pension schemes. But let's look ahead at the future of the pension sector in Africa. Its success will require inclusion, effective governance, digitalization, pension adequacy, we've just heard about that point, but also adequate internal controls and risk management systems in the pension funds. As supervisors, we have been provided with valuable strategies and lessons on how regulators and pension market practitioners can work together to transform the pension sector in Africa for it to become more vibrant, meaningful, and inclusive. I will come back to inclusion. Much has been said about the need to ensure that our citizens in the informal sector are covered. We cannot leave behind the millions of African citizens who are in the informal sector. We know that 80 to 85% of employment is still in the informal sector in Africa, and it is crucial that all Africans have a dignified life during their retirement. Introduction of long saving schemes with incentives targeting mainly the informal sector have proven to be successful and promising in expediting pension coverage. And the case of Ejoheza in Rwanda has been presented during this forum. But we do recognize that more work needs to be done to include the extensive informal sector workers and the self-employed. Other challenges that we are called to tackle as regulators in Africa are the liberalization of pension and increasing the coverage for the active working population beyond the very low 10% that we have. We also have to continue encouraging the use of technology. And I will conclude my remarks on opportunities for the pension sectors in terms of viable investments for the benefit of beneficiaries and members of pension schemes, but also pioneering green investments. The partnerships with telecom and technology companies will provide innovative ways to deliver and scale pension products and will be equally important to modernize the sector. During these 2 days, 11 African countries are participating to this forum. And let's continue to expand the APSF to all our counterparts across the continent. We cannot achieve sustained economic growth in Africa without strong, inclusive pension systems, but also pension funds with sustainable returns. On the regulator side, we will continue to ensure a conducive regulatory environment that will spur the growth of the pension sector, but also increase focus on the financial education, while also allowing innovation to thrive. At the National Bank of Rwanda, the regulatory sandbox that we have set up will also help in that regard in innovation or trying out innovation in the pension sector. Most importantly, close collaboration between African pension supervisors will play a key role in driving the much needed reforms, but also driving a sustainable pension system on the continent. So once more, I would like to thank you all, delegates, for your active participation in this conference. And to those who have to travel back to their home countries, I wish you all a safe journey back, and we hope to see you soon back in Kigali. So thank you all, and I wish you a very good day. And for those who will visit Kigali in the Kigali City tour that's planned this afternoon, please do enjoy your stay. And as I said, we hope that you can visit Rwanda again. Thank you so much.
Thank you very much, Honorable Deputy Governor, for the wise remarks and for really giving us more food for thought. Your remarks are full of homework, and we hope that by the next APSF, we have different stories to tell based on all the deliberations that have happened here. So we are not done yet. We still have one more interesting topic to discuss. We are going to hear from someone who has really contributed to the pension sector and who has contributed to the conversations that we have had earlier. And this speaker is going to discuss pension funds investments in Africa generally. So let's give it up for Mr. Sandeep Raichura, the Group CEO of Zamara Group.
Deputy Governor, participants, good afternoon. I know that I stand between you and lunch, but I do believe that the organizers of this event have kept the best for the last. So I hope that I can still have your undivided attention for the next 15 or so minutes as I talk about a very important subject and one that I'm personally very passionate about. The whole area of investment and sustainable investment, and we've spent a little bit of time talking about this in the last 1 or 2 days. But I believe it's important to say at the outset that pension funds and other institutional investors have a visible stake in the economic health of our countries, as well as in the sustainability of where they make their investments. Now, if I look at the pension sector in Africa, it is still small by global standards. We are at just over $400 billion, if I'm not mistaken. And South Africa has the majority of that. And that $400 billion is actually 0.7% of global pension assets, which last year crossed $56.4 trillion. So we are still way off. But in countries, as well as in aggregate, the size of pension assets on our continent is increasing. And the point we want to make in this presentation is that pension funds have a huge influence and can and indeed should exert an influence in terms of how economies are run, our capital markets, and sustainability of investments based on where, how we deploy our capital and investments, and also the criteria we use in choosing where to deploy the capital of pension funds. Now, this is a very vast subject in itself, but for today's conversation, I'm going to focus on 2 areas. One is the merits of infrastructure as an investable asset class for pension funds in Africa. And secondly, this is an area that Dorothy talked about at length yesterday as well, so we won't spend so much time on it, but this is integrating environmental, social, and governance considerations for sustainable investments for pension plans. Now, I'm an actuary, so I could have chosen to begin with figures to 14 decimal places, but I thought just before lunch that might not be fair. So let me start with some pictures. Can you guess where? What is this? This is a satellite picture of the United States taken at night. Sorry? Okay, all right. So I was wondering, is that lunch really craving now that you want me to get off the stage? Okay, so this is a picture of the US at night. What is this? Yeah, this is a satellite picture of Europe at night. Next. South America at night. Next. Tricia says this is the galaxy. Is that the Milky Way? Africa is literally the dark continent at night when you look at it from satellite. Yeah? But it need not be this way. And it is said that this is the African century. In fact, 6 of the 10 fastest growing economies in the world are from our continent. We are seeing sustainable rates of growth in many countries, stable macroeconomic conditions being implemented in many countries. Technology, as we've heard over the last 2 days, is enabling Africa to make a huge quantum leap and avoid some of the mistakes and things that the West, the more developed economies have had to go through. For example, the penetration of mobile phones, digital payments. I mean, Africa has been at the forefront. We're the leaders in this. And there's no reason why we should not have other ways in which we can show the world what we can do. We talk about this Ukraine crisis and food, but Africa is 60% of the world's uncultivated arable land. Why should we be talking about a food crisis in Africa? Why should African countries be scared about what's happening in Ukraine? We are seeing growing stock markets, financial services sector is growing, the banking sector, insurance companies, pension funds, and all of this is more than a resource boom. It's no longer just about the copper mines in Zambia or diamonds in South Africa or coca in Ghana or whatever it is, right? It's a much more widespread growth that we are seeing. Earlier we talked about the demographic trends in Africa. And in Cosmos's presentation, he shared that the population of Africa by 2050 is going to be 2.5 billion people. It's going to double in the next 28 years. And this means that 1 in 4 people in the world will be African. The population of Africa will be bigger than India and China combined. There's a huge demographic dividend which could become a blunder, a demographic blunder, if we don't handle things well. So, and let's talk about trade. It's really great. We've got common trade areas. We've got the East African community that has now expanded all the way to include the DRC. We've got COMESA, SADC, and now the African Continental Free Trade Area. And do we know that only 15% of African trade is intra-Africa? 70% of European trade is intra-Europe. 50% of Asian trade is intra-Asia. But only 15% of Africa trade is African. Today, if Kenya wants to export something to DRC, it has to go all the way through the Cape of Good Hope to reach the DRC, when a rail network could have, or good roads would have helped that. And the point I'm trying to make is that the prospects for our continent are very, very promising. We are the continent of the future, but infrastructure, or the lack of it, is a big bottleneck for our continent. And infrastructure is a key driver for progress, wherever it is. And it's a critical enabler of trade, free enterprise, and achievement of the Sustainable Development Goals. But we heard earlier that the financing gap, Africa needs about $170 billion annually, according to the African Development Bank, of which close to 100 billion needs financing. And this is beyond the capacity of governments, of donors, or the banks who have been the traditional financiers. And we need to diversify the sources of funding. And pension funds can and should step up to take up this mantle. And this is why I feel that there's an urgent need to diversify the sources of funding. Pension funds, institutional investors should step in. And I really like Gautam's point. He talked about Africa's $1 trillion problem and $1 trillion opportunity. Growing our long-term savings base from what it is hugely important for us to create Africa's saving for Africa's development. And that's something we need to think about as leaders on this continent. Now, let's look at on the other side. We say there's a demand for financing. There's a great need for financing for our infrastructure. On the other hand, we have got a growing pension sector. I talked earlier about more than $400 billion, but look at how the money is distributed. Look at the allocation of assets. In most countries, heavily concentrated on government securities. With the exception of South Africa and Botswana, there's very limited diversification. Botswana, most of the funds are offshore because their legislation has allowed a greater proportion offshore. There is negligible investment in alternative asset classes. If you look at private equity, even though in Kenya we changed our legislation in 2016 to enable pension funds to invest up to 10% in PE, the take-up, and if I'm not mistaken, is still less than 1%. Okay? If you look at infrastructure, hardly any exposure. Now, there is very little investment taking place in the real African economy because the capital markets in which the pension funds are investing are very shallow. If I take the example of Kenya, we've got 52 stocks on our stock market. If you take a typical pension fund, I don't know whether Anthony's here from Old Mutual, but the top 5 holdings are 90% of your portfolio. We have one telecommunications company, Safaricom, that is 50% of market cap. Or I think it's almost 60%. And a few banking stocks. That's all people can invest in. So I'm really happy that we're having these conversations around private debt, private equity, and infrastructure. So there is a need. If you look at the number of listed companies in the East African community, it's only 90. But the investable companies, private companies, is more than 9,000. Now, as the pensions overall sector becomes larger, as individual pension funds become larger in their own right, there is a need for them to look at where else can they put their money. Because putting it in just these two asset classes, fixed income and equities in very shallow markets, is not going to be enough. So there is a compelling reason why pension funds need to do this. And when we talk about infrastructure, I mean, people say this is not something that pension funds can do. And I'm not suggesting that pension funds put 40, 50% into infrastructure, not at all. But test the waters. Let's start somewhere. And why is infrastructure a suitable asset class as part of a diversified pensions portfolio? First and foremost, pension liabilities are long-term liabilities, as we all know. Infrastructure, which is a long-term asset, can be a very good match to hedge those liabilities. Infrastructure investments are typically in the water, power, and the like, where roads, where you can actually get inflation-linked returns if they are structured properly. They provide essential services, so they're less volatile to economic cycles, and also it's a unique asset class in that it is uncorrelated to other asset classes. And earlier, Evans talked about the perception of Africa risk and the reality. Project finance risk in Africa is actually lower than the OECD average, as Evans mentioned. The probability of recovery in Africa is the same as in the OECD, and the blended expected loss is only 0.09%. So this perception of risk is much higher than the reality of that risk. And if foreigners are looking to invest in our markets, why should we not be looking to do the same? And yes, one of the reasons why those figures are much better than the other averages is because there are multilateral agencies, there's DFIs who are involved in this, and again, that's important. But at least it should give the confidence to the pension funds that we can start testing the waters. And this is why I want to share a case study from Kenya, and for a moment, if I can put on my hat as chairman of the Kenya Pension Funds Investment Consortium that was referred to earlier. We're a group of now 24 pension funds. We started off as with the big 5 pension funds. We've now grown to 24 with total assets of about $4.3 billion, which is a third of Kenya's pensions industry. But we've come together to look at opportunities to invest in infrastructure. Now, over the last few years, there's been some work on, but recognize that even for the larger funds, this is a very complex investment class. The levels of due diligence that you need, it is costly. It is the ticket sizes that are needed are quite large and can even be beyond our regulatory limits. And yes, there's some sort of safety in numbers. It's daunting for individual funds to do this on their own. By coming together, we can benefit from economies of scale. We can share organizational technical resources. Instead of doing 20 due diligences by each pension fund, we can have one done. We can have a better seat at the table. We can negotiate better. So, for example, there are 1 or 2 investments in Kenya. For example, the green bond by Econ that was mentioned earlier. I mean, again, as KEPFIC, we got a special deal for our members. If we achieved a certain number, there was the Road Annuity Lot 3 program that just finished. It was heavily oversubscribed. Pension funds played an important role, and KEPFIC was at the forefront of pushing for this and being part of the negotiations for this. So this enables us to achieve scale, and also it's an anchor for foreign institutions, institutional investors. So in the last 5 years, we have hosted 2 delegations from the US. I mean, these are some of the largest pension funds in the US who are keen to invest in Kenya and East Africa in infrastructure. And our target is to mobilize about $250 million into core infrastructure supporting trade, agriculture, whether it's roads, whether it's energy, whether it's rail, or soft infrastructure such as schools, hospitals. Affordable housing is very big in our part of the world. So, and these are small numbers. And all of us have simply committed that we will, over the next 5 years, allocate 5% by 1% increments every year to infrastructure. So it's not, we're just testing the waters, but we have to start somewhere. And I must say it's not an easy journey. There's been good progress, good milestones have been achieved, but we've also had significant challenges. The biggest being there's a huge dearth of investment opportunities. There are many that are presented. In fact, we've had 77 presented to us, but less than 5 or 6 make it to investment grade. And this is where we need to work together. We need to collaborate, all of us, the investment bankers, the DFIs, governments, as to how we can make this happen. Like, for example, in Kenya, we've got a pretty robust Public-Private Partnership Act, which was recently amended to make it much easier, even for our county governments to raise capital. Now, again, we need to take advantage of this so that we can make money for our pensioners, get a good return, and do a great good for our countries. And I really believe, if I can quote the late Zomo Mutuku, he said, you can provide better pensions for your pensioners, whilst at the same time improving the environment they will retire into. So let me now turn, ventures of time, to the second part of this discussion, which is integrating ESG into sustainable investing. And this subject was covered at length in the panel discussion yesterday, and Dorothy talked about it at length, so I will run through it swiftly and perhaps look at how, in a practical sense, this can be done on our continent. But first of all, I think there's too many definitions of sustainable investing, and it's good to be very clear on what it is. The one that I quite like is by Morningstar. It is an investing approach that seeks to deliver competitive financial returns. It is not a sacrifice to returns, whilst also driving positive environmental, social, and governance outcomes. And it's where it's where there's a double mandate to do well financially, but by also doing good socially, while promoting the highest standards of governance and avoiding reputational risk. And it's saying, let's rewrite the traditional risk-return equation to include ESG factors. And I'm not sure how well you can see this, but again, this is from Morningstar. Now, let me say that, and even in yesterday's conversation, the focus was very much on the E side. And yes, it's on the environmental, the aspect of ESG. And that's because of the very eminent, the huge magnitude of the crisis that we face as a world and as a continent. And as was said yesterday, even though we are the lowest contributors to global warming, we are bearing the brunt as a continent of that. So the whole area of water scarcity, biodiversity, climate change is hugely impacting us. Post-COVID-19, there's been a huge emphasis on the social side because everybody was impacted by COVID-19. But the impact on the informal sector, which has been a big part of this conversation, was disproportionately larger. And we are seeing the cracks in the social fabrics of our countries. And it's important to look at that element as well. But in all the other more developed markets, they actually didn't start with the E or the S. They actually started with the G, by working on creating those robust governance standards before advancing into environmental and social areas. And I feel that on our continent, there needs to be a good focus on improving the governance of our companies, improving the governance of our pension funds, of our asset managers, as we try and grow. And as Evans mentioned yesterday, there's been a huge growth in funds, ESG funds globally. You will see that they have tripled, I believe, in the last 10 years. Most of these are in Europe. And why is it that most of these are in Europe? Because Europe has had the most landmark legislation on ESG. So the point I'm trying to make is that regulation or legislation is an important factor. And this was also suggested by a study by Mark at Waddington, that why are you considering ESG? It is because 91% of the respondents said it was legislation that was prompting this to happen. And so if we look at our continent as one of the largest asset owners in our in Africa, pension funds are the most significant players, as we discussed earlier, and could be catalysts for ESG investing in our local markets. In other countries, it was the institutional investors who were the early advocates for this. And I believe that pension funds in Africa should do this. And the regulators in this room, you have an important role that you can play by giving the legislative impetus to make this happen. And have some legislative push. Unless we can create some champions in some of the larger funds, we are not going to see this happen. But I believe that the big opportunity for us is to have a regional approach to regulation if we can, to capacity building if we can, and create some anchors that can attract foreign capital looking to invest in ESG type investments in Africa. A few months back, with COP27 happening in Egypt, as SCEPFIC, we were asked, they want to present investment opportunities on the continent of Africa around water, around energy, renewable energy. We're struggling to find them. I'm attending every county conference in Kenya to say to them, look, you've got these good ideas. Holders need to work together. But let me just go back to regulation. As I mentioned earlier, Europe has been at the forefront. And in Africa, I must congratulate South Africa for being the most advanced. In fact, South Africa was the second country in the world to have a code for responsible investing, CRISA. The CRISA is the Code of Responsible Investing South Africa. And to the other African countries, I say, we can follow suit. And Shem, you're there in Kenya, and Nigeria, Dr. Farouk. This can be done much faster, and the starting point would be just to crib what the South Africans have. I think imitation is a very good form of flattery, Olano. So the South African Regulation 28 is actually very simple. It simply says that the fund has a fiduciary duty to act in the best interest of its members, whose benefits depend on the responsible investment of those funds. And this duty supports the adoption of a responsible investment approach that takes environmental, social, and governance factors into account. Okay? And it's pretty simple, but it has started the conversation. It has started the move. And there's a circular called Pension Fund PF 130, which Olano has mentioned to me is not mandatory. They're looking to revise it. But it simply says that an investment policy statement should contain that whether the fund has a socially responsible investment policy and its definition of it. And there's no reason why we cannot start. We're not trying to bring rocket science to Africa. Don't take me wrongly. But there's a place where we can start. We can take simple baby steps and start the conversation going. So if I were a pension fund, where would I start? So let me put myself now as a consultant and guiding pension fund trustees. Start with discovery. Understand what is in your portfolio. Know what is available in the market that would fit ESG criteria, and design a policy. Again, I think some of this was covered yesterday, so let me not spend too much time. And it's very simple, asking yourself, what do we want to start excluding that does less harm, less damage? Where can we make a difference? And then how do we start looking at the exposure to ESG risks in our portfolios? And I appreciate that all of this would need to be fund specific for a while. There will need to be some level of trial and error learning that will need to happen. Some of it will have to be based on perception, because a lot of the matrices may not be available as we speak now. So reviewing your existing portfolio, there may already be investment. There are already some companies which publish their ESG material. Make a plan, get the motivation right, set out your criteria, consider what is available for screening, what proportion of your assets can meet the ESG criteria, engage with stakeholders, and look at some benchmarks and ways in which you can measure this. Again, this was covered yesterday, excluding, including, impact investing. Let me not spend time on that for now. But look, there's challenges in all of this, but therein lie the opportunities. So there's a lack of awareness and education. But that's where capacity building, often on talking about private equity, for example, in East Africa. Today, nobody's asking what is P, they're asking how do you do it? The same can happen with ESG. There's a lack of adequate data. But again, we can learn by doing, start somewhere, and we can even collaborate across the continent on data. Quarterly capitalism and quarterly focus on returns is a big challenge. So for example, for most CEOs, including myself, I'm told that I'm as good as my last quarter's numbers. And that's bringing a lot of short-term focus. And if I'm a member of a pension fund, I don't know what the situation is in the rest of Africa, but in Kenya, it's a focus on your quarterly, your yearly return. Negative returns not being tolerated. A lower return for 1 year not being tolerated, even though you say this is going to get you a better return by the time you eventually get to retire. But again, we need to garner evidence of the materiality of ESG and how it will impact portfolios in the future. Now, there's a lot of lip service that I see being paid to ESG. There's what is called greenwashing or window dressing. And there's also what is called whitewashing, where you artificially say, you know, that you have got those green credentials and you may not have them. But again, what I'm saying is let's start somewhere. Member resistance, let's look at a gradual approach. And resistance to implementation needs a carrot and stick approach. I believe that as regulators, you can ask your pension funds to start incorporating ESG in their investment policies. Start preparing those plans that I talked about. If they don't do it, encourage them. If they don't do it, start using the stick a bit later. Trustees of pension funds need to do the same with their managers. Force them to start looking at this. Asset managers need to do the same with their investee companies. Talk about it, encourage it, and then threaten to divest if it doesn't happen. So there's a lot that we can do to start. And again, let me just go back to this point about ESG meaning a sacrifice on returns or an investment more morally than economically motivated. Today, that isn't necessarily true. And I believe in Africa, it is definitely not true, because some studies have suggested that good ESG actually lowers the cost of capital, lowers volatility. In fact, all the PE investments that are taking place in, at least what I know in East Africa, ESG is a key focus of those investors. They also display lower incidences of bribery, fraud, corruption. Let me not talk about those things that plague us as a continent. And in the long run, these results suggest that ESG should be get more stable. And yesterday there was a discussion about what will be the perception or views of members of pension funds relating to ESG. As Zamara, we are doing a study that looks at wider issues in which we are also going to be looking at GST, the ESG. The results will be available in October, but there was a study that I picked up by an insurer in Ireland which said females are more likely to look at ESG, consider ESG. Now, 71% said they would only invest their pensions sustainably if the returns were the same or better. And 68% said they would only consider doing so if they were not paying higher fees and charges. So that's some reflections for us on the continent. But to conclude, and I know that the MC wants to push me off the stage, but I think Africa is ripe for taking a different approach to pension investing, including looking at innovative ways to invest in our infrastructure, building our continent, other alternatives, innovative approaches to ESG with a focus starting on the G, moving to the E and the S, serving as an anchor investor to attract foreign capital onto our continent and tap into the funding that has been earmarked for Africa. This is going to take a lot of time, patience, and skill, capacity building, but you as regulators in the room need to give that first nudge and push. So thank you very much. And the usual disclaimer for any such presentation.
Thank you very much, Mr. Sandeep. This was indeed a very good presentation to sort of wrap up with. But before we conclude, let's have a few more insights. This is the last panel of the day, but it's following a great presentation, and I believe we should really hear from this next set of panelists. With that, let me welcome Mr. Gatera Jonathan, the CEO of the Rwanda National Investment Trust. You're welcome, Mr. Jonathan.
Good afternoon. Thank you, Sandeep. It was good, and let me invite other colleagues to join us. I will be brief. I will try to see how we can really digest your important discussion, which is challenging actually. Let me call my sister Mainza. Please join us here. She's a Prudential Supervisor Manager from Zambia. Welcome, sister. Then we have Orlando Makubela from South Africa. We are going to have a brief panel discussion. But maybe the question will be just general. Everyone will be free to comment. Maybe I will start with you, Sandeep. You know, there is where you say that you asked question to some fund managers in Kenya whether they would consider ESG for investing. And if you had asked me such a question, I would say no. Because, you know, being an investment manager of private pension schemes here and looking how these people want a return, considering such alternative assets, it's not really easily digested. And I know people here would agree with me. So maybe just if I were to be convinced, really, I know, even there's where you say that I agree with you in intra-Africa trade is still very low because of the infrastructure. But these alternative assets really, we are always interested in higher return. With somebody here in the morning said, we're interested in higher returns with the lowest risk. So just convince me a bit on that.
Okay. I mean, I could spend a lot of time on this, but look.
Maybe you can be brief.
Okay, sure. So look, I believe that what we need to work on is, you know, educate trustees as well as the asset managers that you can actually get good, stable returns by investing in alternatives, whether it is private equity, whether it is infrastructure, or something else. Your current portfolios are already too concentrated on two asset classes, which the equity market, capital markets on our continent, in our country, is very shallow, not giving you that diversification that you need. Investing in government securities is taking the easy way out. Okay? So I feel that, you know, we need to have those robust conversations, and there is a need to bring those investment propositions that are properly packaged to the table. And this is why I'm saying, let us test the waters. You know, like if you look at some of the infrastructure opportunities that are available, they are being properly packaged. The returns are better, the risks are lower. In fact, there is like the Lot 3 annuity project, and I think, Chris, you talked about it. It had a guarantee, it was a no-brainer. It had a no-brainer because the payment was guaranteed, the timing of payment was guaranteed. Yeah? And yes, initially there will be a need for those guarantees, but over time they can start dropping off. But I'm saying that as your funds increase, you will struggle where to deploy them, and there will be pressure to start looking at these alternatives. And fund managers will be doing a disservice to their trustees and their members if they do not actively start looking at this. Yeah? But those returns, I ran through those benefits of investing in alternatives and infrastructure. But we need to keep harping on that message.
All right, thank you.
And ideas like KEPFIX, sorry, moderator, like, you know, when you come together, there's safety in numbers, you're writing smaller checks, but you're having a seat at the table, those things really help.
Friend from South Africa, you are nodding, so you can have a comment on that.
Yes, sorry for that. So, Mr. Jonathan, let me try and help you on your question and the need to be convinced. So I think we all agree there is a need to earn a decent return, right? But whenever I have these sessions, I always tell people it's good to have a return, but does it matter that much, that return, if you're going to retire in a wasteland, right? So you might have earned all this good return, and you find yourself in a country, in a society which has been environmentally damaged, socially dysfunctional because of inequality, etc. And I think it's an important way of looking at some of these issues. And to go to Mr. Sandeep's point around alternative investments. So, interesting, in South Africa, we have enabled a very wide range of investments. The private equity, and Dr. Osano was talking about private debt, is still attracting probably the lowest investments, right? The irony of it is that it actually happens to be the best performing asset class for the last 10 years. And so we still heavily invested in listed equities. And I think markets are going to move to the unlisted space. So already you see how exchanges are shrinking. Even our own JSE is shrinking. And so I think the sooner we embrace the unlisted markets, and yes, there are some issues around valuation, transparency. I think as the regulator, we can find a way to control for those. So I think, yes, it does help to start embracing some of this alternative investment. But of course, there's the awareness issue. And again, it's human nature, right, which is something I was talking about yesterday, the inertia. You know, something which is new makes people nervous, right? So you kind of need to give them that comfort that, look, there's nothing to fear here, and that takes a bit of time.
If I could just add, moderator, I think there is also an aspect that merits consideration when it comes to perhaps the term that pension funds have to invest. You will note that usually the narrative is around, when you look at the returns coming from the period with which infrastructure, for instance, will span across, it's long and it's expected to be aligned with the liability outlook of pension funds. However, when you come to the African context, you will see that in certain countries it is not the same because of some amendments over time that have allowed perhaps early access and etc. But however, even with that challenge, it is possible that with managing the asset liability structure of the fund, it's possible that pension schemes could participate in alternative asset space as well.
Allow me just to make a couple of points. I think the first one is, I feel that the other challenge that the alternative space has, infrastructure, private equity, is that government bond yields in a lot of countries in Africa are quite high. So I don't know what they are in Rwanda, but in Kenya they're 13–14%. Now what this means is that pension funds take, and their asset managers take the lazy route out. That why take that extra headache or bother? We can just put our money into government bonds and get that return. But if we are to have any hope as a continent, our governments need to reduce their appetite for borrowing and allow the private sector to flourish. So that's one point. The second is, all these things need to start somewhere. So 2 weeks back, I was actually in Canada. I met some of the leading Canadian pension funds, which are pioneers in infrastructure investment. So the Ontario municipal workers, they are now investing 25% in infrastructure. The Ontario teachers is about 15%. And do you know where the most of the money is being invested? It is actually being invested in Asia. I asked them, can you invest in Kenya? You know what they told me? You're too small. Because the minimum ticket size we write is $100 million. But what they asked is, if Kenyan pension funds, if local pension funds are there, we are happy to co-invest with you. So I believe, we need to think outside the box. We need to challenge these, not take the easy way out. There are a few of us who need to take that leadership and force these discussions, because we are doing ourselves, our people, our continent a disservice by not acting.
Well, I'm getting convinced a little bit, but just earlier on, you also talked about African government's social and governance consideration on the sustainability of pension funds. I guess there are some challenges there. Maybe you can illustrate more if I got it clear, because I would think that probably, yes, true, governments, but remember, for mandatory, these schemes for government, it's understandable, but we are now having private pension schemes. And sometimes, as you mentioned, we would want to see where the safest and where you can have the highest return. Like you mentioned, government bonds is around 13.5, 14%. But when you look at these other, like government social and governance for sustainability of pension funds, really, don't you see that there's some really high risk there for, maybe you can just illustrate on that, and then.
I think the one thing that I would want to say again is that, look, investing in alternatives is complex by its very nature. It's not easy. It needs a lot of work, like the due diligences and everything that I talked about. And yes, it is very daunting to do. But in terms of returns, I'm saying one should not necessarily make the conclusion that the return is lower or the risk is much higher. I tried to illustrate earlier that studies are showing that risk in Africa is actually lower. Okay? So I'm saying we need to start somewhere. Like on ESG, my plea today was for the regulators in the room to at least start the process. Get people thinking about it, because that way we will make those baby steps. But the other thing I would say is we don't have the luxury of time. I mean, South Africa has been at this for 15 years. The rest of the continent does not have 15 years. Sorry, I get carried away when I speak about these things.
Do we have some comments from the audience before we wrap up?
CEO Jonathan, we have 2 questions online. If you allow, I can read them, and then you would help me assign who can respond to those. So the most recent question asks, how do we correlate the investment opportunities in Africa and political instability in some African countries with respect to the G part of ESG? That's the question number 1. And then the second question is, why is a portion of the occupational pension schemes charged by the mandatory pension schemes, a case in point is RSSB, charging the voluntary pension schemes? Is that one clear? Or should I read it again? Sorry, there's a lack of punctuation.
Yes, yes.
So, why is a portion of the occupational... But do we have the person who asked this question in the room? No?
No, you read it, maybe we...
Okay. So it says, why is a portion of the occupational pension schemes charged by the mandatory pension schemes? A case in point is RSSB charging the voluntary pension schemes. So what, the way...
Yeah. That question maybe is not clear, but having been at RSSB, maybe I will try to figure out what the person wanted to ask. That we charge the mandatory, the occupational risk. You have to...
So why is some occupational pension schemes being charged by mandatory...
charged?
Yeah, by institutions that would be charging mandatory. But maybe in the meantime we'll figure this out.
Let's first look at the first question about the insecurity. My friend from South Africa, yes, I know you can help out with that. No.
Let me help with the first one. So thank you for the question. Look, it's a hard, good question, and just to give you a practical feel, South Africa for many years had this additional 10% allowance for investments into Africa. And unfortunately, it wasn't taken up. And I know I'm putting my own country on the spot, but it begs the question why South African pension funds haven't invested, up to 40% if you include the 10%. And I think the reality is that people still have these perceptions about Africa, unfortunately. But the challenge with that too is that if you don't have confidence in your continent, you can't expect others to have it, right? So you can't ask people to come and invest in Africa when you yourself are reluctant to do that. So one does need to get beyond the psychological issues. Yes, there is that reality that the politics might be a little bit tricky, but one just needs to keep working on it. Thank you.
Okay, please.
Yeah. I'd like to add that a way perhaps to go around issues around the governance risk that has been highlighted is to try and invest through formalized markets. Perhaps whereas an investment in a social investment like hospitals, rather than a pension scheme giving money directly to the scheme, perhaps you could structure it through some bonds that have guarantees, like the ideas that were shared in the morning. At least perhaps that gives some guarantee to the investor that even post that government's term, then government will be tied to perform according to the commitment that has been entered into. Yes.
Right. I think for that question, you can respond from just when the person clarifies, we can respond just on email,
we can
online.
Keep it on the side.
So otherwise, we would wish to end from here, but somebody from the audience wants to make a comment, please. Go ahead, sir.
Thank you. Thank you, Sandeep. Can you hear me? Yes. I always enjoy listening to Sandeep, and I always love his broader view of looking at things, and thank you so much. On investment in infrastructure of pension funds, I think there's been a broad attempt, at least, where there has been a deliberate effort on an opportunity that has been presented to the schemes. For example, when Kenya issued an infrastructure bond, it was oversubscribed. So I think the appetite is there. But my question is, I get the impression that the schemes need to either structure these infrastructure projects and then be able to invest into them. Otherwise, if that's not the case, who should structure them? How should we should define the demand side of it? Because the investments are enormous. From our market, the Ugandan market, I think the sector is growing at almost 18% every year. So there's an additional 500 million every year available to be invested. So the absorption is still very low. The second point is on the ESG, which I also want to commend the discussion of yesterday and today. And again, the different definitions that have come up today and yesterday, those definitions, which are very, very pertinent. What I picked is that, first and foremost, there's always been an effort to recognize ESG from the E side, the environmental side, but not from the other bit. But from the pension side as a regulator, I think, to me, there are basic things we can do. For a start, number one, can we demand, or probably can have in our guidelines as easy as that, when a scheme or a fund manager is undertaking an investment appraisal assessment of a particular investment vehicle, they consider the detail of ESG, and that should be documented. To me, that is simple. It can be done easily. The second one, in the financial reporting, can we also demand that you go ahead and provide evidence that you actually did some work on the ESG, that your investment details, etc., recognize this. We don't have that requirement or disclosure requirement. It's probably something we can easily do. Those are easy takeaway that we can deal with. Then we can go into the complex bit of it where we're analyzing probably how much extent of appetite that the scheme should have considered in terms of ESG and what were the considerations. That one can be dealt with. But from the journey, that's something that we can probably take away with quickly. Those are my submissions. The second was just a comment on yes, but the first one is a question on infrastructure. Thank you.
So I think to your second point, it's exactly along the lines of what I said. You know, with these, we start somewhere that the regulators can get pension funds to start thinking about this. And that would, I think, be a good first part of the journey. Now, to your first point, is it the pension schemes that come up with these infrastructure? Do they structure them? Do they? No, not at all. That's not the business of pension funds. But the pension funds, you know, once you say that, look, as pension funds, there is an appetite to invest in these areas. And through our experience by coming together as KEPFIC, we are now seeing proposals coming to us. We are being engaged by our government, by private people. In fact, there's more private propositions that are coming to us. And when they come to us, they are evaluated, they are screened, they go through a big test. And this is done because we have a secretariat that has that capability. Again, we are funded by the USAID to do this. So there's the investment screening is done, then the investment managers of the schemes, they look at the investment opportunity in detail. But the important point is that by showing that we are open for business, that we are available to provide this financing, if you package these properly and they meet our risk-return expectations. And we are very clear on that we are not investing for a social cause. We are investing if you can give us the comfort that we'll get the return at an acceptable level of risk. So that work is done by the people who come up with the projects. And we sometimes help them by putting them in touch with the right people. So we are actually actively engaging our government. There are 77 projects on Kenya's public-private partnership. We are going to evaluate each of them and give them the feedback. But the third thing I would say is that we also have a seat at the table, because we are saying, look, we are a 4.3 billion pool of capital. Not that we're going to invest that, we are only looking at 5% of that. But still, that's substantial. But that way, they will engage us. We will be involved in the discussions at the outset that this is the return we are looking for. If it is a private debt, this is the type of instrument and that our members will be interested in. So we will say, if the government bonds are giving 13.5, we want 13.5 plus X, right? That will be the conversation we will be having. And because we are there at the beginning, we will not be thought of as an afterthought. The other thing I didn't mention is that the key thing that pension funds bring is that we bring local currency financing, and we are able to fund for the long term, right? If you look at all the financing of infrastructure, currently it is financed by abroad. Look at how it is indebting our countries, right? If you can provide local financing and you can provide it for a longer maturity, you create a win-win for the country. And I feel these $400 billion in our continent should be used to build our continent. And as stakeholders, we should be there to provide that leadership. So we are not going to get involved in structuring a project, not at all. That would be a big conflict. But we will demand the returns we want, the type of structure we want. We can only do that if we are a force to be reckoned with.
Mr.
Okay,
Chair,
yes.
3 seconds.
Go
I'll
ahead.
be quick. I'll be quick. Just to add, so for fellow supervisors, infrastructure is quite important because it actually cuts across the E and the S in there. What the supervisor can do to aid in that process is to actually signal that infrastructure is a good, decent investment vehicle. And what we have done in South Africa, and this was gazetted literally in the last 2 weeks, we have allowed for infrastructure for the first time explicitly in our investment guidelines up to 45%. And part of that, as I was saying, is to send that message because that's what the industry wants. If you include it in your investment guidelines and it's coming from the regulator, then they kind of have come for that, okay, the regulator is saying this thing, you know, is fine. So that's something for supervisors to think about if you want to encourage investments in infrastructure. Thank you.
Thank you everyone. I think we need to end from here, Ingrid, if you accept, and appreciate your participation. Thank you very much.
Right. Thank you very much to this great last panel discussion of the day. I would want us to do an exercise. I recognize that it hasn't been easy. It's been, yes, very interesting, but also we've spent so much time and you've allowed me to sometimes be a little bit pushy with time. So with that, I would want everyone to stand up and clap for a successful third African Pension Supervisors Forum. Please, let's all stand together. Thank you very much. This goes to each and every one of you who has participated till today. It goes to the organizing committee, and it goes to everyone who has prepared a presentation, to everyone who has sat on the panel, everyone who has helped us moderate. I really thank you, and the entire organizing committee is thankful for you making this a success. With that, I only have a few final announcements, and then we'll be completely done for the day. The first announcement is that the presentations will be shared to all participants, and this also speaks to presenters who have not yet shared their presentation with the organizing team to do so, because we are going to need to send the entire file to all participants for further thoughts and action. Secondly, after now we'll be heading for lunch, but after lunch I kindly request the interim committee of the APSF to come back to this room and have a meeting. The interim committee is going to deliberate, amongst other things, the time and venue of the next APSF conference, and this will be communicated either today during the tour or after on emails, but they will communicate to us the results of their deliberations around the next conference's venue and time. Lastly, I hope that everyone, I hope that everyone who's interested in the Kigali tour has registered. The buses will be here at 3 p.m. and the tour will start after that. Remember to take your COVID test. The PCR testing center is like 300 to 500 meters to the left from this hotel, but we also have our protocol team that can keep guiding you further if you need to take a PCR test, depending on where you're traveling to. Rapid tests are taken on almost every clinic, and still the protocol team is going to help. Somebody must have forgotten their phone in this room yesterday. Please reach out to Bob. He's at the end of the hall. He's going to help you retrieve that. With that, thank you very much for allowing me to host you during this event, and do have a nice lunch.